Good evening. At this time, we'd like to call to order the Finance Committee meeting for the City Council of Palo Alto for Tuesday, October 21st, 2025. Would the clerk please call the roll?
Councilmember Lithcott-Haynes.
Here.
Councilmember Rechtel.
Here.
Chair Burt.
Here.
All present.
Thank you. Now we have an opportunity for members of the public to speak on any item that is within the purview of the committee but is not otherwise on the agenda. Do we have any members of the public wish to speak?
No, we do not.
All right. We get to move on to the first of our two action items. The first being the review of the risk management and insurance program, including funding status of the general liability fund and recommendation to the council to approve amendments in the FY26 general liability fund budget. So, good evening, staff. David, you kicking off?
Yes, I am.
All right.
Thank you. Good evening, Finance Committee Chair and members of the committee. My name is David Ramberg with the Administrative Services Department. As stated, we're reviewing the risk management program and the insurance program. We are discussing this topic today as a referral from council for a deeper dive into these programs and also to bring awareness to the recent steep increase in insurance costs. Next slide, please. We're going to be covering three main areas throughout this presentation. The city's risk management program. As a start, for over 40 years, the city has managed liability risk through the Accel pool, and we'll describe the Accel pool in a couple of slides. Our strong funding and low claim history keeps costs stable and protects the city's finances and essential services. We're also going to talk about the insurance outlook. And recently, there's been a 15 to 25% increase in insurance costs, and these costs are projected to continue through 2028. This is due to rising claims, large verdicts, and fewer insurers available. This has driven up costs for all public agencies. To stay prepared, Accel has increased claims reserves, while the city's growing payroll and exposures continue to impact overall insurance expenses. We're also going to talk about the approach that we're going to use and propose to you tonight. To address these rising insurance costs, staff will propose using available fund balances to offset fiscal year 2026 increases, and also to propose an increase to the general liability revenues and expenses in fiscal year 2027. And rebalancing the insurance fund to maintain reserves and align with our long-range financial forecasts. Next slide, please. The city runs a comprehensive risk management program to protect employees, property, and public funds. We fund the general liability insurance fund at 85% confidence level. This is the top recommended range, reflecting a conservative approach suited to Palo Alto's broader risks as a full-service city, including a full suite of public utilities. From an organizational perspective, I would like to note that the risk management function has recently moved from the Human Resources Department to the Administrative Services Department. That occurred in fiscal year 2024, and this was to align risk management with the financial planning and budgeting aspects that are conducted in the Administrative Services Department. Meanwhile, the Human Resources Department continues to oversee employees' workers' compensation, and the City Attorney's Office continues to manage liability claims. The three departments coordinate very closely to manage the overall risk management and insurance aspects for the city. Next slide, please. As previously mentioned, the city has been a member of the Accel risk pool. This actually goes back to 1986. And Accel stands for Authority for California Cities Excess Liability. And this is a joint powers authority entity. By pooling liability risk with 12 other California cities through Accel, the city shares costs and gains more stable, affordable coverage. This collective approach provides broader protection and long-term savings compared to purchasing insurance independently. Notably, when two large claims recently occurred, Accel covered the costs above the city's self-insured amount, drawing upon pooled reserves that the city had previously contributed into. This prevented large swings as a result of those current claims. We have Connor Bogie from Accel, also from Alliant Insurance Services, here tonight to answer any questions related to Accel or Alliant. I should also mention that Alliant has for 25 years been the administrator of the Accel pool. And through this role, provide supports to member cities as well. Alliant helps market the city's risk profile, secure excess liability coverage, and provide expert guidance on renewals. Alliant has consistently ensured strong protection, cost stability, and continuity for the city's insurance program. Next slide, please. This slide shows the distribution of the cities in the Accel pool. We have a cluster of Northern California cities as well as a group of Southern California cities. Collectively, these cities represent about 1.7 billion in California city payroll. These cities represent a mix of small and more medium-sized cities, as well as other cities that have utilities similar to Palo Alto. Next slide, please. Now we're going to take a deeper dive into the specifics and details of the risk management program. And for that, I'm going to turn the presentation over to Kelly Pogetti, the risk manager for the city of Palo Alto.
Thank you, David. Good evening, Chair and committee members. Staff have identified that the city maintains one of the highest liability coverage limits in California at $65 million. As you can see from the chart, these coverage limits are structured in 3 layers. The first layer is self-insurance of $1 million. Then we share the next layer of $9 million through the Accel risk pool. And then commercial excess insurers provide the final layer of $55 million. Together, this layered approach ensures protection from routine claims and catastrophic events, safeguarding the city's general and enterprise funds, and maintaining long-term financial stability. Next slide, please. In addition to liability coverage, the city maintains a comprehensive insurance portfolio to protect against a range of risks commonly faced by public entities. This portfolio includes around $1.2 billion in property insurance for city-owned buildings, infrastructure, and utilities, and $2 million in cyber liability for data breaches and business interruption. For earthquake exposure, the city currently self-insures the first $1 million in damage rather than purchasing a separate commercial policy. Separate policies would be an additional premium and require more funding. The city continues to explore other options available in the market. In short, our program is designed to balance coverage for typical claims, maintain prudent financial safeguards, and limit costs from rare catastrophic events. Next slide, please. When analyzing how the city's insurance coverage translates into annual premiums, 5 main components were identified: payroll, claims history, claims rate, reserve levels, and market conditions. Each of these components influences the others. The city's payroll growth increased our exposure base, in turn affecting our share of pooled insurance costs. In contrast, the city continues to maintain one of the lowest claim histories and claim rates among peer agencies, which has helped lower insurance costs. However, rising Accel reserves levels and ongoing market challenges driven by large verdicts, limited insurer capacity, and increased reinsurance costs have kept annual premiums elevated for the city. These pressures are expected to persist through fiscal year 2028. Next slide, please. Focusing on the city's claims history and claims rates, it is clear that maintaining a low frequency and severity of claims demonstrates the city's effective safety practices and strong risk management. Underwriters view this as a sign of lower exposure, which translates into more stable premiums and better coverage terms. Within the Accel risk pool, Our excellent record improves our claims rate, also known as the experience modification factor, or XMOD. For context, an XMOD is a metric used in the insurance industry to measure claims experience in the current year. The current national benchmark for XMODs is 1.0. The city's XMOD ranges from 0.8 to 0.86, indicating we're 15 to 20% better than average. This strong standing places us among the top performing SL members and earns us discounts on our liability insurance costs. Next slide, please. Moving on to the other components of costs, payroll, market conditions, and reserve levels. All three contributed to higher fiscal year 2026 premiums for the city. Firstly, payroll. Payroll plays a crucial role in determining insurance costs. The higher the payroll, the more exposures the city needs to insure. In fiscal year 2026, payroll increased by over 20% due to a combination of labour contracts and successful recruitment efforts that filled vacancies. Next up is the current market conditions. Over the last 6 years, the number of participating insurers has dropped. Premiums have increased sharply and underwriting has become stricter. Major contributors to today's market include wildfire risks, COVID-19, and substantial jury awards. Finally, reserve levels. Since 2017, the city's reserve level has remained at 85%. This level is the highest of actuarial recommendations, which range from between 75 and 85%.
Can you say 85% of what? I couldn't figure out what the denominator was, or whichever number. I couldn't figure it out.
It's 85% confidence level, which means that we are funding at an 85% confidence level, yes.
So that means in any given 1 year, we'll have enough money for, so 15% of the time we may have to exceed the claims will exceed what we've reserved. Okay.
Yes, that's the risk that we're essentially taking, is that we're funding of our liability or our risk, we're funding 85% of it.
Okay. And how do we calculate that 85%? We look at our past history and say,
So we have actuarials who perform that analysis for us.
okay,
And we actually have some folks here that can explain that in
well,
detail.
we'll wait
a
after the
little bit. Yeah,
presentation.
sure.
Then. Okay, thank you.
Conversely, actuarial recommendations for the SL risk pool have historically remained at 80% reserve level. Only this fiscal year did the SL board opt to raise its reserve level, given recent claims among members. This has helped the pool maintain financial stability, but inevitably increase costs for all members. Altogether, these components resulted in an estimated 30% increase in excess liability premiums for fiscal year 2026. I'll pass it back to David.
Next slide, please. Thank you. Just the last few slides here. I do want to talk about fiscal year 2026 and what our proposed solution is. This slide shows a starting fund balance in our general liability insurance fund of 2.1 million. We expected in the next line insurance costs being 5.1 million. They came in at 6.1, which is a delta of 1.5 million.
6.6.
Excuse me. Thank you for that correction. Our proposal is to reallocate within the fund about $600,000 and also to draw upon the fund balance of approximately $900,000 to close that gap of 1.5. This would leave an estimated ending fund balance of 1.2 million, which we still think is a sufficient and healthy fund balance for the fiscal year. Next slide, please.
What does that mean to reallocate the balance?
So within the fund, we have other areas that we budget for. And so we're able to draw upon some of those other budget areas where we might
We have
have
some excess
one-time savings.
Okay.
That's correct.
Thank you.
And this slide, we show what it looks like looking forward a couple of years. We do project upwards of possibly $9 million by fiscal year 2028 in excess liability insurance costs. So we are building into the long-range financial forecast approximately 20% increases for the next couple of fiscal years to accommodate those increases. And finally, next slide, please. So the staff recommendation tonight is that the Finance Committee review the report and recommend the City Council amend fiscal year 2026 budget appropriations for the General Liability Fund and do that within the mid-year report that is upcoming. Thank you very much, and we're available for any questions you may have. Thank you.
First, let's see if we have any members of the public wish to speak.
We do not have any members.
Okay, who would like to kick it off? Keith?
The 85% confidence, how do we calculate that?
So Connor's here tonight to handle some of these questions. Connor Bogey is the insurance representative from Alliant, and Alliant handles services for Accel. Connor.
Hi, everyone. Thank you. To answer your question about confidence level, so the city provides loss data to your actuary. Your actuary reviews it, compares it to industry data, comes up with loss projections, and then provides guidance between expected, what they expect to occur, and then confidence levels above that for what you would fund to be prudent, because you would not fund at expected and assess yourself every other year. You'll fund, typically a city hopes to achieve an 80% confidence level funding. So 8 out of 10 years you're overfunded. With that overfunding, you offset the 2 years that you might have a budget shortfall. But over the long term, if you're funding over 80%, you should have a positive fund balance. But outstanding liabilities continue to grow. So going any amount over 80% would be advisable. Being at 85% is ideal.
Okay. And how do you calculate the right number using 85? You have a crystal ball that tells you how much
Yeah.
we're going to get sued for.
One would hope. So what they do is at the different confidence levels, they provide you rates that you will charge yourself based on your payroll. So as your payroll, we use payroll as a measure of growth and size and of operations. And so they'll provide you a rate at each of the different confidence levels. You'll times it by your payroll. You'll fund your internal accounts that year. And then each year you do that again. And then you have your fund balance that hopefully is continuing to grow through time to absorb new claims as they come in. And it's going to be sporadic. You're going to have good times and bad times.
And it's driven just by payroll, or are there other things like number of buildings, square footage of buildings, or number of people in the city, or number of miles driven, or?
Yeah. So for excess liability, we used to analyze everything and the application process and what were we getting to. Like it became more useful to review based on payroll, to look at the size of exposure, and then look at experience and be very experience focused of who's driving the claims costs. Can we get to a predictive layer of claims that will then predict the excess? So that is for liability. That is also how work comp is funded. But in work comp, we also look at employee concentration. So like a city with a large city hall like this might be a greater underwriting concern in an earthquake environment than a city with a smaller city hall. So it's mostly payroll, but then it's also certain things like employee concentration. And then for property, it's total insured values. So it's all your different locations. We report those. And that's the basis. Like payroll is liability and work comp. Total insured values is for property.
Okay.
Aren't we one of the bigger, in terms of payroll, we're one of the biggest in the 11, right? Or
You're
in terms
one of the
number
large-
employees, right? We're one of the top 3, I think it said, in
Yeah.
terms of employee. So our payroll, and given our market, we're probably paying our employees as well as anybody in the pool does.
Yeah.
So our payroll numbers are going to be higher, but I think we said we had fewer claims than the others. So does that mean that we're actually being taxed for the fact that we have more employees, even though our claim numbers are lower?
Yeah, it's a good question. So in essence, based on your particular dynamics, you're in a high payroll area and we would expect low claims from this region. That would produce a greater deposit into an account that then becomes loss sensitive. And we have an a retrospectively rated pricing formula. So this gets really complicated. But you put it like what we're looking at when we look at your pricing, that is a deposit that is a hold to see what claims ultimately develop. What claims ultimately develop and who developed them will cause your final price. So it's not till 4 years later that you see your final price. So you get a 35% discount off this upfront price if you have no claims, in essence. And like members such as call Central Valley, Modesto, Bakersfield, where the same employee might be paid less, but if they have greater claims, their go-in premium will be less, and then they'll be assessed for more cost. Whereas typically Palo Alto is in the position where you have a high deposit and then a refund available. So it kind of normalizes through time through your actual claims experience.
And our rate is based upon our X mod.
Yeah, so it's payroll times X mod times rate equals premium.
And so we've had a very good X mod compared to others, but we also have seen that the last couple of years we've had very large claims.
Yeah.
Is our X mod going to go up?
No, because everyone's having those. So what's unfortunate about the state of California is the rate of large losses for everyone has dramatically increased over the last 4 years. So you are not the only party in this group that is having their first large losses in a very long time. And so when we look at our portfolio of cities, which I'd say is a great portfolio of cities, Excel is top of class in terms of performance right now. And you are at a 84, 85, you're 15% better than the average in the group. So they're all having these to some degree.
And is there a pattern of the root causes for the increase in claims?
Yes. The 3 most common areas of a claim excess of $1 million is dangerous condition of public property, auto liability, and law enforcement liability.
But have those root causes changed, or have the payout amounts changed for other reasons, or the number of claims changed for other reasons? Is our out of each of those 3, are they riskier endeavors in an objective way?
If we think about what's ultimately occurring in those claims, it's bodily injury to third parties and medical cost inflation, cost of living, cost of lifetime care plan, things like that have really expanded up. And the plaintiff's counsel has been very aggressive against public entities. And you have things like litigation financing, where I don't know how much you know about. Okay. So you have a lot of different factors coming together that are targeting public entities and causing very large claims, frequent large losses. And one of the presentations I go around to councils like this when I have the opportunity is to talk about tort reform and the need for tort reform. But that is pushing a heavy ball up a big hill.
So that you got my next question. So we have a set of legislative priorities, and I don't recall this specifically being in our legislative priority. Does anyone know?
I can look it up if you give me a moment, Councilmember.
Okay, good. And if it's not, I'll want to add it.
And to that point, so this group, we have 13 large, great historic California cities. City of Bakersfield has a city manager very interested in pushing tort reform. Burbank has a city attorney very interested in pushing tort reform, but there is not a municipal body that has the budget necessary to take on the plaintiff's bar in Sacramento at this time.
And is the League of Cities involved?
I think the League of Cities is starting to discuss this. But it's a tough topic. It's a tough goal to accomplish. And there's the California Association of Joint Powers Authorities. So like if you think of Excel as one, there's 100 of them. There's an organizing body in California that has a lobbyist, and they are working on it, but their budget is $100,000 a year.
And we have a dozen cities that are a part of our pool. Why aren't more cities part of our pool, and what do they do, and why do they elect to go a different route?
Yeah, that's a great question. Excel is an excess liability pool. In 1986, it was founded, and all the members took $1 million deductible. So when you look at these 13 cities, these were what I would call fiscally conservative. Most of their claims are going to be kept at the city, and they're going to keep the money in-house, and they took a very high retention. So 1986, $1 million, it's not the same. Today, we're still at $1 million as a group. So that might not sound like such a high deductible today, but when you look at these cities, these were cities that took a very, like an equivalent to today of about a $10 million deductible. So these 13 cities all have risk managers. Not all cities have risk managers. To be in this group, you need to have a comprehensive risk management program. You need to have skin in the game, take a high retention, and you need to understand this pool is run very well, very conservatively. So we're in a very hard market for these types of claims that this pool covers. And we're in a positive net position, which is uncommon for an excess liability pool today. So there's the Authority for California Cities Excess Liability, like Mountain View, Santa Cruz, our neighbors that are in this group. You have small cities in this region that are either in the ABAG plan, Plan JPIA, if you've heard that, or they're in Bay Cities. Both of those pools are catering to Milpitas, to Los Gatos, to small cities where you have a low deductible. So you're in a different pool than that. And then there's a large statewide pool that started as CSAC EIA that is now PRISM. And that, if you were to join it, it's a very large, diverse group with a lot of different membership. This group, you're one of 13 board members and you oversee and understand every decision being made. So you have a lot of control over the group you're in.
And slide 8 had, among cost factors, claim history as one and experience modifier as another. But does claim history impact it except through
Yes.
the experience mod?
Yes. So I mentioned that it's retrospectively rated. And so so in essence, $9 million excess of $1 million. And if you think about what you've talked about in closed session, you'll know that that layer, you have large claims. There's a lot of potential claim dollar in there. When we have multiple of those and we didn't prepare for multiple from a member, we have to go back and assess that member. So let's just say you have a $10 million claim. First, you have $1 million deductible, 9 million of it goes to Excel. We have a formula where everyone agrees to split it, but whoever had the claim takes on the most, right? So if you're a member that we didn't expect to have a couple of those, and then you do, all of a sudden you go from having a positive balance available to withdraw to the pool saying, you know what, we need more back from you. And that's called the retrospective rating calculation or the RPC calculation. And that the city did receive an invoice for this year for the first time, I think, ever in over 30 years.
Oh, no.
I have an answer for you, Councilmember. Tort reform is not in the guidelines, so we will include that. It's going to policy and services in November and then to the full council for approval in January.
So we will simply bring up to PNS that this came up in the finance committee meetings as something for their consideration.
Okay, thanks.
Okay, yeah, jump in. This is a discussion. It's not so much solo. So the 85% confidence, that means 15% of the time we have, how big is that tail? Do we have any insight into how big the tail could be?
Yeah, for workers' compensation, I'm sure you probably have claims from 30 years ago still open that you're struggling and trying to close. But these things evolve over. For workers' compensation, that tail is very long. For liability, it's much shorter. Usually you receive all your claims with, I mean, you can talk to the city attorney. I'm not an attorney, but usually receive all your claims within 2 years. If they're large ones, you're litigating, you're delaying court dates, and generally they resolve in 5 to 6 years. So that's a much shorter. And property, you're resolved within 18 months, 2 years.
But the 85% confidence is in any given year, we have an 85% chance of having enough in the bank to pay for everything.
So the way that I'd look at that is your actuaries and look at your loss history and say, like, what was your worst year? What was your best year? How often are they close to the worst or the best? And then they come up like with probabilities. And it is unlikely that you would go over 85%. Like, so let's just say they tell you should fund, let's keep it simple, $8.5 million at the 85. If you're going over that, you're going over that infrequently and you'll borrow from the fund balance that you've accrued.
Okay, that was my question, is what happens in those years where we spend more than we expect?
Yeah, so we at Excel and you at the city are probably blending all of your years together and saying we have a positive balance, we can continue to fund at 85, or our balance is declining, we need to increase to 90%, which is one of the things that Excel just did. was Excel's coverage is really right in the crosshairs of this large litigation for large claims. So they were funding after the financial recession from 80% from 08 till 2020. Then they went up to 85. Now they're at 90, which is you're starting to go as high as you would reasonably go before you start alienating members, right?
Okay. Christine, can you bring up slide 6, please?
Is this Tycho drumming outside?
Yeah.
This is my
Incredible.
most fun insurance presentation.
I bet.
Yeah.
I unfortunately have ADHD, so I'm going to be highly distracted. I'm going to try to stay here though.
Okay. So we have this pooled layer and we have the self-insurance. And so we effectively, the pooled layer is costing us something and the excess insurance is also costing us something. Which is most efficient? I assume
So-
the pool is,
If you look at that chart, the gray is your business. That stays at the city, right? That's between you and your actuary. The green is a pool financial pool risk financing vehicle that we administer, and that small green box from 1 to 9
Mhm.
costs the same amount as from 10 to 65.
Oh, it's just, well, I mean,
By chance, I have it here. We could show you the breakdown. So like if you think about the dark green box, that costs you about $3.5 million, and all the way up to 65 costs you 2.8.
but part of that is just the chance of having an $11 million claim is pretty slim.
Well, it's much more likely that you have multiple $10 million claims than a 65,
Oh,
right?
okay, yep.
So I would also say about the green, if you don't have claims, we return you the premium. Whereas if you spend it on the insurance, it's their profit, right? So you, take away the fact that we have elevating losses, like that's a problem. But otherwise, you would prefer to put your money into Excel than into the insurance market because we work with Chandler Asset Management to invest our funds in alignment with the government code. And any investment income we get, we return it back to the member that drove the income. So if you have a large deposit, we give you a larger amount of our interest, and then that stays as credit, and then we'll give it back to the city if we don't need it.
And so can we work with the pool and increase that 10 million?
Yes, they are. So part of this is the insurance market pricing comes to our board, and our board makes a decision that it's no longer worth it to buy at like you can see in 2021 to 2022, we left the $5 million attachment and moved to the 10 million. That carrier from 5x5 would either have said, I'm not doing it anymore, or I'm driving the price up so high that we've turned to our actuary and said, what can we self-fund this for? So in today's market, we're starting to prepare the pool to go to 15, then we'll prepare them to go to 20 and then to 25. So when Excel was founded in 1986, City of Palo Alto was on basically in a claims history, like I don't want to go too historic, but like claims started to develop against municipalities for the first time. Cities lost their coverage. They formed these JPAs. They did it without any of the light green, any of the excess. So Excel was founded with the member Palo Alto. You had a $1 million deduct retention. You had $9 million through Excel, and that was all you had. Right. And then we, as Excel, took all the insurance premium from the market. Now the insurance market is greedy and wants to come back and take it back because they stop seeing the claims because we're paying the claims. Short memories, and then they start coming back. And so as it gets cheaper, we'll drop that retention. As it gets more expensive, we'll increase it back up. So yes, we're preparing the board to increase that. That's part of the 90% confidence funding strategy is you're going to need a lot of money to fund $25 million claims. And we need to start having it available because as soon as you click over coverage, we could have a settlement come up within 6 months where somebody says, okay, now I need 25. So we have to have a reserve built up for that.
Okay. And the 1 million has been 1 million for a long time.
Yes. So
Should that be changed?
should it is a very interesting question. The way that, so I'm the administrator of the pool, I give the board, whoever our board member is, just fair advice for the pool. If I were an entity with high payroll and low claims in this environment, I would take a high retention. I'd take a high deductible and I would save my premium dollars and I would bank on the fact that we're not going to continue to have large claims. This pool has been one for all for one. They've all stayed at 1 million. They analyzed like good members and bad members and said, well, Anaheim, Bakersfield, Santa Monica, if you have more claims than our other members, should we push you up to a $5 million deductible? Reviewed that actuarially, said that would not benefit the other members. They actually, in fact, because their payroll is so high, produce more premium than their claims, even though they have so many claims. But for the Mountain Views and Monterey's and Palo Altos of the world that aren't having those large claims but have high payroll, they should self-want the higher, they shouldn't be pushed up. But if we present you a quote with a higher retention, it might be so attractive that you would choose it. So I think that will be the method. So they go through a strategic planning every other year. We've been talking about increasing the self-insured retention since about 2021. And we've done the analysis, and there hasn't been a reason to push members or request increases. But I think we're getting to the day that the finance directors and the risk managers are saying, well, now I see why, let's choose to have the higher retention. So I think it's gonna be member self-selected, and I imagine they're gonna create options from 1 to 5. And then it'll be up to the city if you want to save on the premium dollars, and whatever savings you have, please insert it into your own account under risk management. Don't put it somewhere else as
Yeah,
savings.
so, yes, don't spend it.
Yeah.
Okay, so we have larger claims now. What's the types of claims? And
Yeah.
is there anything we do to reduce the chance of that
For the city,
for the city?
Yeah.
For example, if auto claims are high, do we put dash cams on every vehicle?
yeah. The number one thing I would always focus on is de-escalation training for law enforcement. All of the training that you could provide to law enforcement to help them perform their job as well as they can without making mistakes that ultimately do happen. That is the number one area where you might see a department that doesn't have a good strategy and like repeated claims. That has not been Palo Alto's experience. Palo Alto's experience has been kind of unfortunate, dangerous condition claims where somebody tripped and fell and bumped their head, and they had a very expensive head. And like, so for some of that, you cannot trying to have design immunity for things like intersections, crosswalks, making sure you have good records, good engineering plans, good city attorney review of, did we get council to approve these plans? Did we keep those plans? Did we execute the plan as designed to obtain design immunity? Would be one of the things that cities could work on. Do you guys know about design immunity for dangerous condition of public property? All right, so if you have an engineer who signed off on a plan and so let's just say the school came to the city and said, I want to build a mid-block crosswalk next to the school to promote kids using the mid-block crosswalk. If somebody just put that there and there was no plan and it was never approved by city council, somebody could sue you and say that's a dangerous condition of public property. You do have some going around on a lot of different terms here, immunities for design. If you properly went through the review process, it was a safe design, you approved the design, and then you built the design as designed. And then in a court case, you could prove that it was safe. Then you can get out of some large dangerous condition claims. But generally, cities don't have great records as to like, how did that intersection end up? Like, it's been there for 30 years. Like, we don't have the plan from 40 years ago. I don't know how good Palo Alto's records are, but like that would be something that you could work on. But again, that's a very large project to make sure that your whole city, all your sidewalks, crosswalks.
So this is probably an area that I ought to speak up. And so that's correct. That design immunity is a key strategy that agencies can use to limit their dangerous condition liability. Palo Alto, in my experience, compared to other cities that I've worked with, is generally very good at this in terms of both our record keeping for existing improvements, existing facilities, but also in terms of the way we deliver our projects and, deliver our projects through public works engineering. So for example, you can do things like when your project is completed, you file a notice of completion that gets recorded, and that shortens the time when anyone to be able to file a claim against that improvement, right? And so our procedures are generally very good when it comes to buttoning up things that we have control over.
In general, that design immunity sounds like it's an issue, but for our claims and the pattern in recent years, is it correct that it's been more on construction in streets and accidents related to that of bikes and pedestrians? Has that been our pattern? Do we have have we done a systematic analysis on what are the significant claims and what are the trends? And then even aside from what we can look retrospectively at, what we can anticipate might be additional sources of risks.
I'm not aware of any systematic analysis. I can say that the two large claims that we tendered to Excel over the last, I believe it was 2-year period, involved catastrophic personal injuries, and were the first both of that nature and of that sort of severity or magnitude that the city has seen in a very long time. So if there's anything to read into those as anecdotal data, it's that we generally do a very good job. Sometimes you have folks who encounter really bad luck, who are also very expensive folks because of their stature in life.
But one of the real challenges in risk mitigation is seeing what hasn't happened, essentially an accident waiting to happen. And what I think we and other agencies and really socially we do in general is that we do a better job of reacting retrospectively than saying, oh no, I just walked past that. That's an accident waiting to happen. And if you bring it up, the response is, well, that accident's never happened. You must be wrong until the accident happens. So the challenge is really getting a culture and a mindset that looks for and responds proactively to risks before they've been actualized.
Would also add that one of the benefits to Excel is that you have a risk management department here that's now exposed to 12 other cities of what they're dealing with. So we do get to see what happened at the other agency and take lessons learned back. And through Excel, we have the ability to solve problems that might have happened here more uniformly for everyone. Like maybe an insurance solution doesn't work for one city, but if we have 13 cities and enough premium, we could start to bring on solutions for risks that the city is exposed to.
That's right. And since as we're looking at what risks are highest, we have a limited a set of data points of our own actual occurrences, although we want to look at those sub-$1 million ones as well as the over $1 million, because we may have lucked out and the guy only bumped his head bad as opposed to gotten paralyzed or whatever. But we may also be informed by these other agencies and what they've experienced, and at least gives us an opportunity to ask ourselves, do we have similar risks and we've been lucky until now.
And I'll just add and pipe in here to your point, Chair. Staff is obviously being proactive on, what a risk may materialize versus the one that is materializing is challenging, right? None of us have a crystal ball, but as we've been tracking claims and we've looking at experience both with Excel as well as just our own, we are working with our staffs to make sure that we are instilling that culture of safety. See something, say something. If it doesn't look safe, stop the job site. when we're doing traffic control plans for those capital improvement projects, because I think you've probably seen we've got a lot going on in the city, whether it's the cities or others. You know, we have instructed our staff to do an extra set of, you know, relook at that. Did you really take into consideration how close you are to a school? Is this a bike throwaway? Do we need to put in extra traffic safety because of that? So we are having those conversations and instilling in our teams that this is important. And so, you know, the typical is maybe not enough. And so I just do want to reassure the committee that, you know, as we are tracking these claims, we are also working with our teams to make sure that it's not just oh, that would be unfortunate. But if you see something like that, do something about it, say something.
And following up on that, so there's one category where if someone is involved with a project to see those risks. There's another thing of all the personnel that are out in the city with eyes and ears. And when I brought this up with the city manager a year, maybe 2 years ago, about whether we have this culturally as a responsibility of every worker in the city to be observing and reporting things that are outside of their direct projects, or even a public works person seeing something that might be utilities or vice versa. And the response was that that would run counter to the culture. People wouldn't want to make work for fellow workers. And I
Don't be a snitch. Yeah.
yeah, and I found that real troubling, and I would want to know whether that has changed in a substantive way, because I think that's an important thing. We have,
Sure.
I observe things all the time that I see as risks. We have 311, a portion of those are risk-based that community members do. And as we're looking at the financial implications of these things that we had spoken about from either an isolated circumstance, or that might be a liability, or just otherwise, now we're seeing what's really happening, and much of this is outside of our control. The tort issues certainly are. As you mentioned, our police de-escalation, I think, is now very good, and a few years ago it was less so. So we've turned a number of the knobs that we can turn, but I want to really understand what remaining ones we could turn.
Yeah, none of these things are easy. But one of the things that watching these in closed session, I get frustrated about that might be easier to accomplish and check in before the loss occurs, and this has happened to other members, is in your police department with your vehicle pursuit policy, making sure that all officers are trained every year on that policy, because that is a key difference in the defense strategy of those claims. And those claims can be $15-25 million each. And it really hinges on, did every single officer in the department train on the pursuit policy annually? And like, they should. So like that's one that I would really focus on, because that's the difference between a defense verdict and you're paying lots and lots of money. And it's,
I think we're strong there as well, but we'll be interested in following. Yes, I'm hearing that. Julie?
Just had a follow-up, and I'm not sure if he's done with his line of questions, but just to stay in this topic and the plaintiff's bar, aren't we sort of advertising to them where they should try to be settling their claims, given that we've got these tiers? So if they know we're in the Excel pool, they know we've got this group pool up to 10 million, then we know they've got, they know this, right? So are they sort of incentivized to like push as high as they can, you know, with it? Like, we think we can go to 10 because we know they've got the pool till 10, or we think we can get this to 20 because they've got the outside layer to that. And then we know our max is 65. Like, how many of these
yeah.
aren't settlements influenced by the fact that we're in this pool that's sort of a public matter?
There's some that believe that argument. I would say that there's plenty of case examples where it went well over policy limit. You can look at Los Angeles Unified School District currently and what they're dealing with billion-dollar settlements where they do not have that sort of like insurance to back it up. There's also been Apple Valley got a $65 million jury verdict. They only had 50 million of insurance. So there are examples I could point to around the state where
You said jury verdict, though. I'm talking about settlements. So if it's sort of inside baseball, they know right?
Yeah.
Get it to a jury, who knows? But if it just seems to me that we're sort of advertising what our capacity to pay in an insured manner is.
Yeah, so cities have to declare a lot of public information, and one of them is like you would have to declare what your policy limits are. So, and that's all you could do is protect the city as best you can.
One more question, just what's the process for lessons learned? Like if other people get sued, other cities get sued, or if we have lawsuits, how does that percolate down into the city and change actually our real risk?
Yeah, so if you look at like how you would place your risk options, what's unique about Excel, what's the benefit to like get back to lessons learned is that you have a litigation manager through Excel who works with your city attorney, who's hopefully seen all the claims that you're about to have already. So they'll already know who the best defense attorneys are for this type of claim. If it's something with really bad bodily injuries, using structured settlements, making sure that the city is aware of how to engage those and how to use those in negotiation. So you do have an outside set of attorneys through Excel who are helping to make sure that your city attorney is guiding it to the right defense attorney, not just in your city attorney's opinion or whoever makes the decision, but in our opinion as well. And so we're a supportive party to the city, not an adversarial party to the city. But that's would be one of the benefits is you have a litigation manager who's overseeing all of your claims with any exposure over $250,000 has been reported to Excel for monitoring. And you have an outside set of eyes on that. And if there were things like policy recommendations where something was incorrect, we'd be working through our counsel and your counsel to make those recommendations back to you.
And so how do we get this behavior down to the individual employee? Is it through the attorney or through the HR or through risk management? What's that flow?
I mean, you're talking about organizational culture at that point, and making sure that employees understand their role, the city's values, and
So how's the information, if some other lawsuit settled down in Southern California, we realized, oh, we have that same liability, who informs the people on the street that, hey, this happened to another city, be careful about this?
Sure. Sandra, do you want, since you've perhaps been that linkage for us in the past?
Yes, as the former board member, I would bring that information back to city departments. Just as a quick example, most recently, I think last week, we talked about e-bike safety, given that the city has a small fleet of e-bikes and, let Kelly know, oh, there's a training going on through the PRISM organization that we're a member of. And so that actually is the training that employees must attend in order to ride our e-bikes. So that's just a small example of.
And then if they crash an e-bike, they have a worst case? So, I mean, there's two ways of doing it. One, you want to prevent the crash. The other is if it occurs, you don't have liability because you did due diligence to try and prevent the crash.
Well, in the example I'm giving, if an employee is riding our e-bike, we are responsible. They are our employee.
But if you gave them guidelines of how to use it and they violate those guidelines, doesn't that protect you?
There's two kinds of claims. One, are you talking about if the employee was injured?
Yeah.
I think Sandra may be talking about if the employee injures someone else. Is that right?
Yeah, two separate areas of responsibility. The city would be responsible if the employee is injured. But if a third party is injured, then
Correct, yeah.
would be a claim
But
against
if you
the
gave them
city.
training how to avoid it and they did something and wiped out and hit their head and they were violating, for example, they were using a helmet or something like that.
They would need to be negligent in order for the city.
And they'd still be eligible for workers' comp even if they were negligent, right?
There's certain rules about like horseplay,
So there's
doing something.
Torts class in law school is full of really, really creative hypotheticals. The ones that really stuck with me always involve trains. So we have that. But I think in addition to the organizational culture, which Kylie touched on, there are things that we do internally, for example, within the city attorney's office to really stay on top of this. So we do have a dedicated attorney who's 80% of his time is spent managing our litigation portfolio. We monitor very closely our stable of outside counsel who we retain for tort defense, specialists in civil rights, specialists in employment, specialists in personal injury. And then, of course, we are monitoring all of the developments in municipal tort litigation. I think the battleground for claims really is in all of the different statutory immunities that exist, and so that landscape is evolving every year, and so we're monitoring those developments in the law very closely. And when there are takeaways, for example, in sidewalk maintenance or tree protection and things like that we see happening in other cities, we do make it a point to bring that back to our clients and say, hey, tell me about your policy around, traffic safety for tree work or things like that, and try to give them some actionable steps to shore up our practices for the safety of our community, but also help avoid potential exposure if a claim does materialize.
Thank you.
Yeah.
I don't know how my colleagues felt about this, but I felt that just switch gears now to the suite of topics for which we have insurance coverage. Cyber liability seemed low to me at 2 million, just given the era, right? Okay. So, and then when I read that it was further segmented into business interruption, presumably related to cyber, breach response related to cyber, it somehow felt even less adequate.
I would recommend you buy more cyber liability coverage.
That was not meant to be a softball to get us to pay more money.
As an insurance. No, I mean, honestly, I would be at least a $5 million limit. And I could provide the city benchmarking data, but I would support that you should buy an excess policy. And I would say that on earthquake, you're also exposed without coverage. So those are the two, like if I got to walk in here and talk about two things I wish you would buy that you don't, it would be an excess cyber policy. And if you're not purchasing any earthquake coverage, do you have a CAT fund internally where you're ready? And if you're not, and you've already drawn it down, then it would probably be a good idea to supplement that with either a parametric triggered earthquake policy, which Excel just implemented for all the members, most of them joined, or you could do like a traditional earthquake policy.
What is parametric earthquake policy?
Yeah, it pays you for business interruption expense rather than worrying about your structures. It's a quick payout based on a pre-agreed scale of like, if we get the 7.0, we're going to, within 60 days, send the city $6 million because they're going to need to pay whatever. It doesn't have to be building damage. It's a different way of looking at earthquake where we're protecting your balance sheet and your ability to recover after the event without just focusing on the rebuilding structures.
So this is a new line of insurance that Excel has been looking at in the last year. And so that is being discussed. It is, with it comes a high cost for the insurance. So that is under discussion to bring at the appropriate time.
And if it's an excess limit policy or liability, would that be through Excel or would that be outside of Excel?
You could do it either way. There's an advantage whenever you could buy it through Excel. You have to admit that you're okay with sharing risk with other municipalities. If you're okay with that, then you will always get a better price through the JPA.
Okay.
Almost certainly always. There's always.
And Sandra, were you referring to the quake policy or the quake and the cyber?
I was referring to the parametric.
Quake.
Mm-hmm.
For cyber, that is a city decision that would be purchased by the city. And that sort of policy, we do not usually discuss publicly too much.
Okay. One thing I wanted to bring up in this whole kind of culture of safety and risk mitigation. So at Caltrain, where I'm on the board, during the construction of the electrification of Caltrine, they had a whole series of incidents that we're still paying out on, and really a problem. The CEO brought in, soon after she took over, got authorization, brought in a new position on Chief Safety Officer. And he was very strong and looked at both internally at all of our workforce, and then externally, our system and the risks that we pose. And that agency went from worst to best, basically, in 2 to 3 years. And so I'm really interested. We don't have a comparable position here in the city, right?
We do. Utilities has a safety officer just for utilities, which is, of course, a large exposure. Fire and police have their own training officers that also review exposures, their calls, improvements, vehicle training. As far as the rest of the city, it is based on supervisors reporting either risk or new exposures. So we do it inspections on more on a case by case need.
Okay, I think that's something we want to think about. And then I did want to ask the impact on the budget going forward. Well, two things maybe. One, on the adequacy of the let me see if I can pull a slide. What's it? Slide 11, I think. Of the fund balance, we had $1.5 million more than we projected just this last year. And at first it says for FY26, and I was confused how we know the numbers for FY26 when we're still in that.
This is 25-26. So the premiums are shown here as an increase. The starting fund balance, that's the June 30th of 2025 fund balance, correct? So the starting fund balance there is June 30th of 2025.
Okay. But we're saying that we already know what the variance is for FY26, and we're still in the midst of FY26.
Correct. And so it's a premium that is set by the pool approximately May and June. It's discussed during May and finalized in June by the pool board. That was concurrent with when we developed the budget, but did not make it on time for our budget adoption. And so since then, that premium affects the current fiscal year we're in.
Okay, so that is important to be clear on, because that means that inherently we have an adjustment that would occur around this time of year, every year. Is that correct?
Yes,
It
and
could be an adjustment up or down.
it's been insignificant and just absorbed within our budget. This is the first year in a while where it's gotten to this level of magnitude. And so hence we're bringing it back as an actual adjustment before the Finance Committee and then subsequently to the council.
And our estimating fund balance, which we think is adequate, is less than the funding adjustment we've had to do this year. So it makes me want to make sure that that fund balance is adequate.
It is important to realize this fund is an internal service fund. So the source of funds is all the other city funds paying into it based on an actuarial study that identifies a pro rata share. So to your point, I hear you. I don't think any finance person, myself included, would want a fund to end in the red. And this is one where we do have control over the sources that are coming in and can make adjustments as necessary.
Okay. And in the staff report on slide 12, in those years of projection, we actually have on graph 1, it goes back to 2021 and shows that gradual increase that I think was that 5%. Now the big jump this year, which is, would you say it's almost a 25, let's see, almost 25% jump? Was a combination of payroll increase and the claims, correct?
And market conditions.
And market conditions. And we're showing a projection of 2028 of going from 4.9 million in 2025 FY to 9.5 million in 28. So 4.5 million increase. So our long-range financial forecast shows what in it right now? Our previous, most recent one that we had received before this information. What had we projected would be the costs in 27 and 28?
We previously had 5 in the current long-range financial forecast. So this was an unprecedented increase this year that we had.
But 5 for this year, FY 26.
Yeah.
And then, but it's the long-range forecast. So what do we have for 27 and 28?
We had 5 continuing through those years. And we're making those adjustments in the upcoming long range.
We
with
showed
the new
no increase in the forecast?
5% each year.
5%,
Yeah.
not
yeah.
5 million.
Sorry.
Got it. Okay, 5%. So the dollar amounts are what in the forecast? So I'm trying to understand how big of a jump in dollars we're now going to see in the financial forecast as a result of the difference between the 5% and what we're now projecting.
Right. So there will be a significant jump, and this is what we're going to need to work through with Excel is the reliability of some of these forecasts. As you noted here, right, we're going from 5 million to 6.5 to 7.9 to 9.5. The general fund is about 50% of this internal service fund. So we're going to need to look at ways to see how we can offset these expenses and also determine if these increases are truly going to be the near-term reality.
Okay, so when we're making the projections for FY 27 of almost 8 million and 28 of 9.5, are you saying that we're not ready to build those into the long-range financial forecast?
We will build them in to the extent we get more confidence from the pool that these should be the level of increases. And then 2 is we need to figure out a way to fund them because we currently do not have this level of growth in our long-range expenditures.
Okay, I see the paragraph above graph 1 says that these projections may impact the long-range financial forecast. So I was mystified why it was may as opposed to will. Is it more accurate that it will and we just don't know how much?
True.
Okay,
Yes.
so let's get that so that when it goes to council, there's no ambiguity that it will. It's a significant factor, but we're trying to mitigate it or whatever is the explanation that you would add to that.
Yes, we'll bring it back as a part of the long-range financial forecast discussion.
And when would we see the next long-range financial forecast?
December.
Okay. Okay. So one of the things that, I did want to, one other final thing on e-bikes. At first, when you brought it up, I thought you might be saying that because of the proliferation of throttled e-bikes and kind of reckless behavior by private citizens, could we be experiencing increased liabilities for whatever behavior they may have? But are there circumstances where that risk may be transferred to us?
Unfortunately, state of California, it is a very difficult state for you to defend yourself and say you are not at all responsible. So joint and several liability, they're going to try to get you for 1%. You got a pothole. Doesn't matter. They weren't wearing a helmet and going 35 and had a six pack. If you had a material defect in the bike lane, you're going to be in a hard defensive strategy.
Or if we have the circumstance that we're seeing, we have a closed pedestrian street that we allow, our intention is to allow low-speed bikes, and we have sets of teen e-bike riders who are riding pretty recklessly.
Yeah.
Does that pose a risk to us?
I would say yes. Yeah, you look at City of Carlsbad just declared a state of emergency over e-bikes when school started, I believe this year or last year, and they started a program between the school district and the local police department to get not licenses, but something where you couldn't arrive at the local schools unless you had something like a license that said you were aware of the safety and risks.
Interesting.
So there are steps that Carlsbad had a lot of claims come in and they declared that emergency.
Got it. Okay. So in addition to forwarding this to the council, I'm interested in whether the committee would want to attach certain recommendations that the council endorse. One is that we evaluate increase liability insurance for both cyber and quake. Second, that we add the tort reform to our legislative guidelines. Third, that we have we request staff to do a systematic claims analysis, that we look really at the patterns. Fourth, that we get an update on kind of our safety culture, including risk reporting by staff. And fifth, that we evaluate the adequacy of senior safety positions throughout the organization, as opposed to just in some circumstances relying on supervisors to really do that. So I want to see what colleagues think about whether we want to refer those items to the council.
I appreciate the list. I wonder if we could get a little feedback from staff as to the scope of what we may be proposing.
So first, let's start on the fiscal impact. Our thinking was if the committee agrees with the proposal, we would just wrap it in as a part of the mid-year adjustment. That way, we're not doing a separate staff report for the purpose of just this budgetary change. I think that's a matter of administration. Let's bifurcate some of the asks on the table, and one in terms of additional policies and coverages, and two is a continued deeper dive into risk management. Ask for additional policies and or coverages. I think we've heard today that as a risk team, we could bring this back to our pool, who is here representing, and then in our interest, evaluate additional coverages in balancing the additional cost. We can bring that back as a part of our budget development in 26-27. That'll give us some time to, I believe, take the vote we need to as a part of the pool, right?
Yeah.
And then align that with our budget development process so we can evaluate premium increases as a cost and a priority in the balance of other costs within the city, and it's not evaluated in isolation. Two, there is a level of concern that we continue to have very in-depth conversation about risk claims, programs, and gaps in this public conversation. So I would ask that, I think we've heard the concerns, which is how do we debrief? How do we create a stronger culture? How do we deal with close calls? How do we circle back organizationally? I think that's incumbent upon us locally as staff and also in working with the pool. to bring that back. But I would be concerned diving in a lot deeper, given that there are trade-offs in those conversations publicly.
But we can still recommend to the council that the council endorse that systematic approach. The product of that approach, if it's confidential, that can be provided to the council confidentially. We don't have to then have the review of that product publicly, as I understand it. And then maybe Kyle, if you can
What is the
give us some insights
What
on
is the
that.
approach? I believe we are already doing a systematic approach, so can we clarify a little more what this is bringing
Well,
forward?
if I don't know what, and I think we don't know what systematic approach is really being taken. We heard a description of some fragments, and we don't know if that is everything. Is it adequately comprehensive? And I think at the high level, the council would want to understand what are the components to that approach, the full set of components to what staff is evaluating, which is different from scrutinizing the specific resulting elements and staff actions.
So I'm hearing an ask for both a greater contextual or historical understanding of our claims and our general exposure to claims, but also a look forward into what we need to anticipate and how and what I'm paraphrasing here,
historic of ours and partner cities.
Okay, historic of both the city and our, I guess, fellow members in the JPA, as well as a forward-looking analysis or recommendations on how we might adjust our different coverages, as well as perhaps some operational adjustments for how we do our business as a city. I'm afraid I don't know what the best forum to provide that all of those answers is. I can tell you that from the standpoint of the city attorney's office, we do provide regular litigation updates. And so perhaps one thing that we could do is work with our risk manager and maybe take a first crack at some kind of insights into claims patterns or things that we are seeing maybe elsewhere that have some intersection with the business that we do here in Palo Alto or areas of interest that the council has expressed. I can't speak for the other departments on how they might come back and develop some responses to what you're asking for, but that's certainly something that we could.
And I'll just say,
talk
in
about
terms of the forum, I am comfortable with respecting whatever is the recommendation of what should be public and what should be confidential.
Certainly, and with respect to any type of information that does tip our hands, so to speak, we will certainly avoid anything that would do that.
Sure. I guess I'll take this from an operations standpoint. That I'm cognizant that this item is coming to you because it was a referral that we wanted to go into this, and now we are continuing that referral with further analysis. So I'm not saying staff can't do those things. I do want the committee to understand this does impact capacities. And so, I think, and our representatives from our risk pool can help us understand better, but to put this in context, I know and appreciate, frankly, one of the reasons why I think most of us continue to push ourselves in this organization is we like to always elevate the bar. And what can we do better? How can we improve? And I also want to recognize we're doing good. And so when we look at that in comparison to this request for additional analysis. I do respectfully like to understand to what end. Is it information? Is it for changes? Because some of this does get into operations. And some of it, and I think to your point, Chair, you nicely laid out, I don't need to get into necessarily the details, but kind of what are the policies that the city has to manage risk?
So first, I want to say that when we look at that we're doing good, I assume that means that by comparison to others.
Correct.
And just like with the point I've made on wildfire prevention, we fall into the trap of asking ourselves, are we doing better than we did before? And are we doing good compared to our neighbors? As opposed to what today do we understand about the real likelihood and severity of the risks?
Sure.
And that needs to be the metric that we're telling ourselves, that we're holding ourselves to. And I don't disagree that by comparison, we are doing good. But when the whole risk level has gone up, whether it's wildfires or what's happening in litigation,
Sure.
That's what's prompting the concern that have we got to up our game even more?
Which totally fair. And that's part of, to your point, managing risk in an organization. And I guess where I'm trying to come from is understanding the committee's end goals of this in conjunction with the other things going on. You've got other fiscal priorities and fiscal constraints that you will start to be facing. And, to Lauren's point, I think one of the pieces will be right on evaluating things like a safety position and additional insurance, is this where we would like to invest financially at this moment in time versus some of the other service priorities? As someone, I think you always hear from the finance folks, and we've had dialogues historically, and some of us can be too conservative, and so the council has helped us push to be a little bit more moderate in our assumptions, and so if trying to understand
when
the
we
priorities.
look at 3, 4, and 5, we can take it from the lens of, gee, are we going too far? But are these fundamentally wrong for an organization to be doing? Looking at these claims systematically rather than piecemeal, really looking at and getting an update on our safety culture. And then lastly, structurally, a question, do we have the right staffing for the safety culture that we are wanting to have? I don't see those things as overwhelming tasks, but I do see them as very important ones.
I would just add that, to Assistant City Manager's point about funding, I think on number 5, that really needs to come as a part of the budget development. So if there is an assessment that we need one more safety officer in X department or as a general, we need to see that in the context of other budget
Yeah,
priorities.
this is raising the issue, not concluding it. So this is evaluate adequacy, which would then go into, if the conclusion was we're good, it doesn't make it even to the budget. If the conclusion of looking at that says, we've looked at it and we have a bunch of departments where we're relying on supervisors to be chief safety officers, then maybe we need to look at the organization, and that would then go into the budget. All this is asking is that we look hard at it.
Right. So maybe the way the motion is written needs to be modified. So it's not necessarily a recommendation to the council, but really committee is directing that to staff, who are all the risk folks right now, to evaluate that. And if it's
I only
adequate,
said it to the council because a question of whether the authority of the committee to give that direction,
Correct.
absent the council.
Which I appreciate. Chair, and I think there's no disagreement, and this dialogue is really helping, I think, us maybe hone in on the intention of the committee and where staff's at and resources. for me, one of the things that's really kind of sticking a little bit is item number 4. And I'm wondering if the chair would be amenable to lifting this up to be about risk management and safety practices and policies. When we talk at the granular level of reporting and, what's happening at the staff level.
I'm okay with that. What would be your recommended wording change?
Perhaps that. Christine, did you? I know you had it like right there.
Christine's on top of it.
Safety policies, I guess, and safety policies, risk management and safety policies.
Okay, and delete the final
Right.
clause.
And I do think it does beg that question in terms, as the city attorney said, and you appreciate the flexibility of the forum in which we provide this. I guess one of the pieces is the intention for there to be a dialogue around this, or, one option could be, here's a list and here's an overview, right, of all of our risk management and safety policies.
My assumption was that if the council endorsed this, then it would get back filtered again through the finance committee at some time, whether in pieces or in whole, over the coming months or year.
Fair.
Like the safety officer.
Sure. Come through the budget.
Presumably that
process.
would be
right.
Evaluated in advance of the budget.
Right. I hear you. Okay. I think, and if we stay mute on it, then we can work through the information and the form in which it comes back. But I also should check in with staff in terms of this higher level and our, what are our risk policies and practices versus that more, and being able to provide that. And ultimately, to be honest, it's a combined across many people that this would be something. This is a cross-departmental type of review.
I'm just kind of thinking out loud in terms of the current cycles and items that we typically bring to this committee as a part of the budget development. We usually have a segment for ASD and budget development, which would include risk now. We can bring back some of these items in that forum without creating a whole separate item before Finance Committee, because Finance Committee does have quite a robust agenda slated for the upcoming months. And I want to just be efficient with our time.
Julie?
Just we're good. We're in a fortunate position to be the city we are with all the planning and results that have come from that. And I want to caution us to never be too self-referential or self-reverential, to always be interested in raising that bar, even if it just puts more daylight between us and everybody else. The second thing I want to ask, Chair, is, are we missing an item 6? I'm not sure if we are, but I did hear Connor mention the importance in terms of risk reduction of ensuring our public safety or law enforcement personnel are trained to de-escalate and have an annual vehicle pursuit strategy training. And I
didn't bring it up because I felt familiar enough with the reforms that we did.
Okay.
In 2021 and the results we've seen since then through our IPA audits, and it's one area that and if I'm wrong, I'm open to that, but my understanding is that we've really in the last 4 years or so developed a whole set of policies and then a very good implementation and adherence to those policies from everything I've been able to understand.
Good, then I'm good.
I did want to just kind of add and in a way apologize. So this mindset, Keith is literally a rocket scientist. I say our job isn't rocket science, but if we need one, we got one. And if you think about things like space shuttle and that, and how that mindset becomes cultural in an organization and one of continuous improvement. And I come from 35 years in an industry that was the backbone of what we did was use of hazardous materials. So from a safety standpoint and environmental standpoint, we were just incessantly dealing with that. Not to mention that we're also in an industry that semiconductor manufacturing where literally the mantra was zero defects, which sounds like an impossibility, but that was really the culture. And so that's why some of these things that may sound like they're aggressive in an organization, they're somewhat second nature to us.
Yeah, and I come from a touchy-feely background of undergraduate education, and we had the same goal. You know, how can we be best in class regardless of what other people are doing to foster a sense of belonging on a campus where people might otherwise feel like nameless, faceless numbers. So continual pushing, I think that's part of, you know, that's a value that the city holds. That said, we don't want to rob Peter to pay Paul. We know that there are a lot of other competing demands that are coming, and you know best what else is coming within the context in which we're trying to slot this.
Keith?
So I have two reactions. For number 3, I'd like to expand that to include a mitigation strategy. We have lessons learned, okay, but how are we going to implement those lessons? And number 5, when Pat first said that, I kind of hit my stomach got a little queasy because of our finances, right? But then I looked at that plot over in the staff report and showing that we basically are going to be up almost $5 million in costs in the last 3 years. And so maybe a couple positions would save us money, even though we're spending money, we're actually in the long run saving money. So I think evaluating this, I think, is a good thing.
Yeah, at Caltrain, I would say, and this doesn't in any way say what we should do. It's just evaluate. But at Caltrain, the chief safety officer position has paid for itself at least by an order of magnitude, and I think far more than that. And so it's a question, is this an expense or a cost saving? And that's what we need to look at.
Yeah.
So committee, couple things. One, I think I just want to be clear. I was not trying to identify that we should stay stagnant. I frankly started my comments with, we have a culture of let's always move that bar and let's manage moving that bar at a pace in which we want to make those investments and have the bandwidth to do it in the context of council's priorities. So I do want to make sure that the committee doesn't walk away thinking staff are complacent, and that's kind of our perspective. So I just want to say I think we're all on the same page on that, which is wonderful. Ticky-tack, I'm wondering if the chair would be amenable to us changing the following additions in the motion with the following referrals to staff. And that way it will separate for us right now as it reads, all of this comes back in February.
That sounds great.
Wonderful.
Yep. And, you know, the problem is that really the playing field has changed. Yeah. It's a good thing to do to begin with. And now we have a tougher playing field.
I second the motion.
Okay. On that note, all in favor? Aye. Passes unanimously. Thank you. And that was a very informative discussion. And I just say that we felt like our questions were answered in a real clear way. So really appreciate it.
And the Chandler guys had to call home and say, I'm not going to be home for dinner. Hope this has been a good preparatory conversation for you.
All right, so we get to move on to our second and final item, which is the investment advisory services overview. Thank you. Welcome. Christine, do you kick this off or? All right, welcome.
Good evening, Christine Paras, Assistant Director of Administrative Services. Just a quick overview. Council approved the transition of investment management to a specialized firm in the 2026 adopted budget. The contract with Chandler Asset Management was approved by council in June. And earlier this year in the committee's review of the investment policy, the committee wanted to have more information and discussion on what the transition would look like to a specialized firm. So we've outlined that in today's staff report. We have Chandler Asset Management to present their overview, a firm background, and some initial observations that they had that we've implemented since they began working with us in July. So with that, we have Carlos Oblitas and Neil Murthy from Chandler to present their overview.
Before you do that, Chair, may I just say one thing? Ms. Paras, I think, if I recall, because I think I might have been the one to say it, we were a little surprised that the city was making a pretty major decision to move some pretty important analyses from in-house to outside contractors. And we hoped we would have been consulted before that decision was made. So we've gone forward with it. And yet I think that context still remains. Like, this was big, and we felt sort of out of the loop on why do we need to do this? And should we do it? So I just want our Chandler colleagues to be aware that that's at least an aspect of the backdrop.
And not with an assumption one way or another. We just didn't know.
Yes, appreciate that clarification. And part of our goal this evening is to provide clarity to the committee on our outlook on the city's investment program and keep you in the loop. So before we offer an introduction, just want to be very complimentary of staff as we begin to our partnership. They've been very thorough and diligent as we've been kicking off our partnership. I'll offer an introduction. My name is Neil Murthy. I'm a senior relationship manager with Chandler. I'm actually based over in Oakland locally. And my role as it relates to the city is to ensure your satisfaction with our services and provide client support. I'll also offer, Carlos, if you want to introduce yourself.
My name is Carlos Oblitas. I'm a senior portfolio strategist with the investment team. I'm part of the team that makes decisions on how we're going to position your portfolio and carry a strategy through. I was also the person that was tasked with developing a strategy for the city. I can get into a little bit more detail on how I do that because it's very specialized and customized. What I will tell you about our process is that it is very transparent. We don't want any secrets, no black boxes, and we want you to understand when we make decisions why we're making them or why we're recommending them. So we'll talk a lot. We'll answer all your questions. That's what we're here for. I've been doing this for 30 years. I've had the privilege of doing this for 30 years. And I've had a couple of years on your side of the table as a finance director for a local government as well. So I've seen both sides of it. I understand the pressure points that elected officials and policymakers like you have. We're very sensitive to those things. And we hope that that will be demonstrated through what we show you tonight.
Thank you, Carlos. And if we can go over to the next page. One more. Thank you. I'll provide a brief overview of our firm as a background. So our firm, Chandler Asset Management, we derive our name from our founder, Kate Chandler, who had worked as an investment officer first for the County of San Diego and then for the City of San Diego. And then she identified a need among public agencies for additional expertise in terms of managing their investments. In terms of our company structure, we are an ESOP. So both myself and Carlos have equity in our firm. We've been providing expertise to public agencies for over 37 years. We do have our headquarters is based down in San Diego, but both Carlos and I are local to the Bay Area. I'm over in Oakland and Carlos is in Marin. And what is it that we do? We provide customized investment programs tailored to our clients' investment policies and within the confines in the state of California, within California code. Important to note, we are an investment advisor under the Investment Advisors Act of 1940, which means we are a fiduciary to the city. We have to put your interests ahead of our own whenever we're making any decisions on the investment portfolio. We provide customized strategies that are tailored to your needs and also your risk profile. We also have a stable team of professionals with an average of over 2 decades of experience. And we have structured, repeatable processes that we use to implement our investment strategies, and we'll discuss that in further depth. So if you look at the
pie chart, the assets under management, $4.42 billion as of the end of the second quarter. I think what's more impactful is our dedication to public agencies. With our founding as a public agency members, 80% of our assets by dollars are invested for public agencies. We do have a large healthcare client, so that number actually goes a bit higher if you do it by head count. It's about 95% by headcount or public agencies. And then within the state of California, we have a deep breadth of experience. About 75% by headcount are California public agencies. And if we go to the next page, you can get a better illustration of that. So by the numbers, we work with over 165 public agencies in the state of California. More impactful for the committee might be that we work with over 70 cities in the state, and then within the 9 Bay Area counties, over 20 cities, including, there's a lot of names on there. It's a representative list.
The
on all.
bolding designates what?
Those are our Northern California relationships. And then I'll just call out the city of Campbell, Cupertino, Milpitas, Mountain View, and Sunnyvale are some of the neighbors that we manage funds for. And also notably to Excel, that is the city's risk manager, Connor. We've been managing funds for Excel for over 20 years. So we have a deep breadth experience, and we've been have some exposure to managing the city's public funds by way of your risk manager. And we do have a deep bench of professionals that develop our strategies. So with that, I'll go to the next page and pass it to Carlos to discuss.
How many employees do you have?
Employees are over 50.
We're 53.
53?
Okay,
Thank you, Carlos. Yeah.
So I can get into some of that, but before I do want to mention that we know Excel quite well. And not only do we manage we've been indirectly working with you for many, many years. We also manage out of the 13 cities in Excel, we manage 5 of those as well. We're all over the place. The slide that you have here is a breakdown of our investment team. These are all the people that are involved in the investment process. It's a pretty deep bench. Most of us have multiple decades of experience working in the field of investment specific to fixed income management with the mandate that is similar to the city of safety, liquidity, and return. Most of us have local government experience when it comes to investing. We've been doing this for a long time. I'm part of this team. The other person in this team, which I'll introduce in the next page, we'll have a little more in detail, is one of our co-chief investment officers, Bill Dennehy, who is the city's portfolio manager. The way I like to think about it is I come up with the strategy and he executes it. He makes it happen every day. He stares at the Bloomberg terminal daily looking for the opportunities. We are organized on a committee basis and we work on a team basis. Let me explain both of those things. The committee basis is just simply that we look at the different risk parameters and those factors that drive return in the portfolio, and we organize ourselves around those risk parameters and factors, and we make decisions, and all our analysis is based around that, and then it's taken together and done as a team within the entire investment committee. When I say that we work on a team basis, it's that all portfolios have backups. So it's not just Bill or one person managing your portfolio. If something were to happen to Bill, people talk about getting hit by a bus, I think of hitting the lottery. If Bill were to hit the lottery tomorrow, there's a deep bench of people who are ready to step in, who know what the city's needs are, what the city's investment policy dictates, and also what the city's direction is going to be. Out of those committees, I actually co-chair one of them, a multi-asset class committee. That's a committee that we do a lot of post-retirement medical trusts and Section 115 trusts, and I help set the direction of that committee myself. If we go to the next page, this is the direct team that works with you. I mentioned Bill Dennehy, who's our co-chief investment officer. He has 33 years of experience. I've got 30 myself. Neil's got 16 and has been in the business for quite a long time. As well, we have Stacy Alderson. Stacy is our client service director. She and her team make sure that our numbers get crunched, that our reports and our statements, monthly statements, get updated accurately, and that are delivered to our clients on a timely basis. If we go to the next page, this is a brief overview of how we think about building investment programs. And it might be best to look at the graphic along the top. It's just an arrow looking at it from left to right. There are components that must be in place for us to make decisions on the investments. When people when we walk into a room, they look at us and they think you're either lawyers or you're bankers because you're wearing these ties and the blue coats. And the reality of it is that we like to think of ourselves as solution providers, and this is how we go about providing solutions for local governments. With local governments, you're a specific and a very special kind of investor. You're governed by California government law, and California government code is very restrictive, as you're aware. So we always start with making sure that your investment policy is up to date and it takes in most recent changes to California government code, that it also encompasses the best practices as identified by various industry groups that are recognized in California and nationwide, and also by some of the best practices that we've identified over the years. Without that, a program is kind of dead in the water. We are experts in California government code. We get consulted on by various industry groups and lawmakers when it comes to updating the code to make sure that what we're doing is what they're proposing is workable and also in line with the objectives of safety and liquidity, which are also mandated by California government code. From there, we typically like to understand how a city is using its cash because these are operating funds for the most part. There may be bond proceeds associated with this which have a different risk profile and a need and may be subject to a draw schedule, but we like to see how the city is using its cash, how it's spending it, how much cash comes in and goes out, and what those cycles look like. We typically work very closely with staff to be able to determine that, and I'd like to report to you that we did just that. We ran a statistical analysis and collaborated with staff to give an overview of how the city uses its cash. That allows us to understand how different pockets of cash are used and be able to then develop specific strategies to those specific needs. Prior to this approach, what we were able to observe is that the city had sort of a one-size-fits-all approach to all the investments. And one of the things that we've worked with staff is to develop specific strategies for specific needs. You'll see some of that down the line. From there, we developed those strategies. I'll get to that and I'll talk about a little bit about that in more detail in a moment. But basically, what we're looking at are two different approaches. Those investment strategies that are applicable to your shortest investments, meaning those monies that are needed quickly, that you need them for daily payroll runs, for AP runs, to make debt service, to pay for in July when you make your lump sum payment to CalPERS. We think through these things and how these things flow through the city's books, and we want to make sure that we have money available for that, and that's one strategy. But we also recognize that with a $550 million investment program, you have monies that although your general fund and your different funds have a claim on these, some of them are going to be static for some season, and they're going to be sitting in that portfolio, and we need to optimize those as best as possible. So there's a separate strategy for those funds, and that strategy for you, in conjunction, we've developed it in conjunction with staff, has been a total return strategy, which I'm going to describe a little bit better. But basically, it means an actively managed strategy that emphasizes not just interest income, but within the confines of safety and liquidity, but also fair value appreciation. And we'll talk a little bit more about that. From there, when we do those three activities, then we focus on the active management, the day-to-day management of the portfolio. So we do the heavy lifting on that, and this is where we really bring efficiencies to the table that the city did not have the advantage of being able to tap into simply because of resources. So what that means is that we have a credit analysis process so that when we're taking on additional risk, there is a risk mitigation process to allow us to do that. If we're buying credit securities, that means that we're doing credit analysis on these securities. We're not just buying securities because they have a credit rating. We don't rely on the credit ratings alone. I think the global financial crisis proved that, made that very obvious to everybody. But everything that is in the portfolio has been vetted from a credit standpoint, and it makes sense. It's appropriate for the city of Palo Alto, and it furthers the portfolio in a direction. There has to be a reason for every security that's in the portfolio that's being purchased. There has to be a reason for that security to exist. If we don't have a reason, just because it looks like good yield is not good enough alone. So there's a reason for everything, and we have to mitigate any risks that come into it. And not only that, it's also just efficiencies that we have being a $42 billion shop. We have access to the markets. Prior to us coming on board, your staff, they did as best as they could, and they worked with perhaps 2 or 3 brokers, just a handful of brokers. We worked with 45 different broker dealers so that when we're going and purchasing these securities, it's the difference between buying rolls of paper towels at 7-Eleven versus Costco. We're able to leverage those relationships. We're able to go directly to the national desks of primary broker dealers and get better pricing, which over the long run mean more return for you. What else can I say? It's also focusing on safety and liquidity. It's making sure that funds are available when needed. It's making sure that we meet the requirements of code and your policy, and it's making sure that we identify opportunities for the city over the long run. We're steady plotters. Safety and liquidity portfolios aren't. If you think of the Aesop's fable about the grasshopper and the worker ant, this is the worker ant portfolio. This is how it functions. If we go to the next page and the page after that, there were some observations that we had on the portfolio. I'm going to get into some more details, but the very first ones right off the bat were that we needed to have a better idea of how the city was using its funds, and we did that through the cash flow analysis that I mentioned earlier. And one of the things that we noticed is that the city was not utilizing certain liquidity vehicles, liquidity investments that are readily available to local government investors in the state of California that were providing an outperformance because of an anomaly in interest rates for a season, which we felt you should take advantage of. So we first bifurcated the program into what I described, those longer funds versus the shorter funds, and look for avenues of generating returns safely for those shorter funds, and then reserve that total return strategy for the longer funds. Right off the bat, we were able to identify that you can use more of the state pool, right? Especially as rates are dropping, that tends to hold its yield a little bit longer. It's generally a very well-regarded and competently managed program, widely used in the state of California. You're a member, but you weren't utilizing it as much. The other thing that we looked at was what you were doing in your banking relationship. If we think about how the mechanics of the investment program, you own these funds and these securities, and these securities sit at a third-party custodian bank, and those funds are held in the city's name, and no one else can touch those funds but the city staff, and they have obviously safety protocols and just risk management protocols to be able to manage all of that. We, as your investment advisor, never have access to your funds. So when we purchase a security, it just means that we go to the markets, we go to the street, and we enter into an agreement with a broker or dealer somewhere, and we purchase that security, meaning we enter into the trade. We transmit that information to the custodian, and the custodian basically clears that trade. They do something called delivery versus payment. They pay for the security and in turn receive the security. We, as your investment advisor, never have access to your funds, and that's a very important safety measure for the city. That's how you avoid a Bernie Madoff situation. So when that occurs, there is usually an amount of money coming in and out of that portfolio. And one of the things that we noticed is that the city had a practice of when coupon payments, interest payments coming into the portfolio would come in, they would just automatically get wired out of there into an operating account. And from there, they might get wired again into the state pool or may stay there. And in none of those vehicles, none of those places were you utilizing an investment vehicle to earn something on that very, very, very short-term cash. So one of the things that we did is we collaborated again with staff to establish a sweep vehicle at the custodian, and I believe that the staff has already completed a sweep vehicle at the operating bank as well. And for those of you that may not be familiar, what that means is that when cash comes in from a coupon payment or a maturity, those funds don't just sit and earn nothing. They get swept into a very short duration, high credit quality, very liquid money market mutual fund. And while it may sit there for a few days until it gets reinvested again, it earns something. That's just something you weren't doing in the past. And now you have that, and now you're earning more money as a result of it safely. So we're looking at these operational efficiencies and again, collaborating closely with staff to make sure that we can capture money wherever you can safely. If we go to the next page, you can see what your investment program looked like as of the end of August 31st. You had a market value of $541 million. And this is the entire program. You can see how it's broken out in the pie chart on the lower right-hand side. But there's a couple of things that I want to highlight here. Your yield, that's what you were earning back then, was 2.46%. That's generally, when I look at portfolios your size with the parameters that you're able to work with, that tends to be on the lower side.
That was the current yield or the
That is
the
that
yield
is the
to maturity?
purchase yield. That's the yield to maturity, the yield that you're due to earn into the future on an annualized basis based on what you currently hold in the
Yield to
portfolio.
maturity. So,
Correct.
I mean, the whole yield curve is well above 3.4 right now. Right?
That's
So
correct.
how did we get below the current yield curve?
The reason you got below the current yield curve is if you look at the term structure of the portfolio, which is the chart to the left on the bottom, it shows you that you've got monies that go out all the way to 10 years, and you had a practice of holding to maturity. So in many instances, you were buying securities that you purchased during the pandemic when yields were zero.
We were locking
and you
that
were
in.
basically you were locking it at the most expensive part of the business cycle when yields were at their lowest, and you were holding on to them for 4, 5, 6, 7, 8. Well, the longest maturity was 9.6 years. So it really dragged your yield down. This is a program where you can actively manage this portfolio. Let me go through the observations because I think it'll speak to some of this. Your credit quality was strong. There was never any problem from that sense, at least on paper when we look at the credit ratings. But you did have an outsized allocation to municipal securities. Again, very high credit quality. Muni defaults are very, very rare. But you were buying a lot of those issues were so small that they were a little bit illiquid. If there is an emergency and the city needs that cash and you need to sell out of it, you would have taken a significant haircut because the issues were so small. Only few investors owned it. And I've got it. In fact, let's go to the next page. I've got an example of that. This next page is a Bloomberg description screen on one of the securities you hold. It's a very high credit quality and a desirable bond, Santa Clara Valley, California Water District. It's a revenue bond that you were pulling off of the revenues pledged to pay this bond off from an enterprise. That issue had $2.3 million outstanding. They'd paid off the rest of it. When they initially issued it, it was more like, in fact, it was about 36 million. But this is a serial bond where they paid off quite a bit of it. Out of the $2.3 million, you owned 1.5 of it. You owned 66% of this issue. If you needed to sell that in an emergency, there's no one else to buy it because you own 2/3 of it. So this is an example of a lack of liquidity that we'd like to address in the investment program. So that's one of them. You have an outsized exposure to municipal securities. Actually, they make up almost 2/5 of the portfolio.
So how does it work for taxes? What taxes do we pay when we earn interest? Do we pay any taxes?
You are not a taxpayer.
Okay. So with muni bonds, you're not getting as high as the treasury even.
That's correct. For the most part, if you're purchasing a muni bond, you typically look at the yield ratio between the treasury security and what they're paying. And if it's a positive ratio above 100%, if it's 101 or something, then the yield is attractive. Or you could be buying taxable issues, which don't have that yield, that tax advantage, where the yield may be higher.
And so if a muni yields above treasuries, does that mean that there's some credit risk?
Well, there's always credit risk with everything, including the treasuries that we've seen in the last few months. But what I can tell you is no one is still to this day, no one is considered as safe as the U.S. Treasury. So for the most part, there are instances where you may get a little bit of a lower yield or a flat yield, or it can vary depending on market circumstances. It can vary depending on issuance, how much the municipal market is issuing. It can vary with what the Federal Reserve is doing, and it can also vary with fiscal policy, which, as we're all aware right now, is a bit of a flux given the policies of our current administration. Okay. If we go back to that page number 11, I think that's some of the things that I also wanted to point out. I mentioned the small issues. A lot of those municipal bonds tend to be on the smaller side. From the federal agencies, you own 32, about a third of the portfolio. So 60% of that 32%, that makes it 20% of the portfolio were callable federal agencies. They have a call feature that the issuer has the ability to call them back early. Think of getting a mortgage in your home and rates fall and you want to refi your mortgage, so you pay it off early and you go back and get a lower rate. Well, that issuer does the same thing with these bonds, except that the person getting paid the interest is you. And it means that if they call it back because rates fell, which rates have been falling, it means you're getting your money back sooner than you anticipated, which means that from a duration, that's a risk measure in the portfolio. From a duration standpoint, it's very difficult to control that risk profile. But more importantly, you're getting money back when rates are falling. You're not going to earn what you thought you were going to earn, and now you're going to have to reinvest it at lower yields, and you see income coming down. So we really like to limit what you have. In fact, when we purchase callable securities, they have to make sense. The conditions have to be very specific for them to make sense. It's a little bit of a technical analysis, but that's one thing that we identified. We would want to reduce those. Your longest maturity extended out to over 9.5 years. We like that your investment policy allows you to go beyond 5 years, because we have clients where we do that. City of Sunnyvale comes to mind, and that's been very successful. But in the 30 years I've been doing this, I have yet to see a city whose operations can withstand a maturity this long. We typically see maturities this long for folks like Excel that run workers' comp programs where the average duration of their liabilities is out to 3.5, 4 years, and their longest durations are out to 10 years. So it's a mismatch with the operational needs of the city. So one of the observations is that we want to ratchet that back. That is additional risk you're taking on. We call that market risk, because the longer you are, the more volatile the value of those longer bonds are. And that's additional risk that you shouldn't be taking on. It doesn't support your overall operational structure. And as I mentioned, the yield is not dynamic because you buy and hold, and you're buying and holding out to 9.5 years. And we have the ability to analyze a bond and sell before maturity and reinvest and determine whether we're going to be better off doing that and earning more by doing that than just having sat on our hands and waited for it to mature. We do that every day. So all of this to say is, if we go forward to page number 13, so these are the initial observations that we had. You have a large municipal exposure. That is a little bit of a decrease to liquidity, although that from a credit standpoint, it's a great sector to be in. But we'd like to have more liquidity. So gradually, because we do things incrementally, there's no shocks to the portfolio. Like I said, we're steady plotters. We're not going to overturn this overnight. We'd like to decrease that exposure to a more manageable exposure. Similarly to the small issue, we'd like to start purchasing. We already have. We've been purchasing issues that are much larger. They're called benchmark size issues. They're big enough to make the benchmark, basically. And those are widely held and have robust secondary markets with investors lining up to purchase those. That's additional liquidity. When we talk about the federal agency exposure, at the moment, it's not very favorable to hold federal agency callables. Those will likely have to we'll have to let them run off the portfolio, because as rates fall, their value keeps dropping more and more. And if we were to get rid of them today, you have a significant unrealized loss on your books. The fair value of this portfolio has dropped significantly. I think that's reported to City Council under the provisions of the investment policy, and that a great deal of that is due to that callable exposure. So we'll likely let those run off gradually. With those holdings longer than
them above par, or why it'd be a loss on the
because callable agencies, federal agency callable securities, tend to have very little of the upside when markets rally and all of the downside.
Oh yeah, understood. But why would we lose money? Oh, compared to the market value, or compared to
correct compared to the book value, the carrying value of where you purchase them at, where you carry them, and versus where the market what the market pays for them. That's a negative value.
We bought them on the secondary market.
Correct, although that's not what's making the negative value. Okay. So those holdings longer than 5 years, we would want to ratchet that back. We may purchase some securities beyond 5 years, but not much longer. We do have a strategy that I'll get into in a moment, but we'd ratchet that back. Right now, your yield is 246. We would like to implement a total return strategy. Generally, that approach is you're wanting to enhance interest income and fair value of the investments, both, or at least protect the fair value. You can't control that because we can't control where rates go. But generally, the way that this is done is we pick a duration target. A duration is a risk measure. It tells us how much the market value of the portfolio will move for a given change in market rates. And it's a risk measure for us, and it's the biggest determinant of risk and return in the portfolio. We would target, we're already targeting a duration target. And as the portfolio ages every day and gets closer, it gets shorter every day if you do nothing. We periodically rebalance with tactical sales before maturity to get you there. But every sale is done, well, first of all, because this is new to the city, one of the things that staff, to protect the city, had requested of us is that before we do a sale before maturity, we have to check in with them. And when it has to make sense to them as well before we do that. So there's oversight in all of this. I told you that this is a transparent process. We don't work in a black box. But generally, the idea is to maintain that duration because we can observe what the expected return of that duration can be over the long run. We can also get an idea or an indication of what the overall volatility of that duration target looks like over the long run. And we observed or we analyzed with staff what different duration targets look like and what they mean to the city from a fair value standpoint and also from an income standpoint. And we worked out that we would want to keep the investments primarily between 1 and 5 years. Sometimes they'll be shorter, sometimes they'll be a little bit longer, but you're going to average somewhere around 2.5 years. You're at about 2.5 years right now, so that's not too different. The difference is that you've got tails of investments on both ends. We need to ratchet that down and get a little bit more control from a risk standpoint on those. Any questions so far?
I've moved from how come you didn't tell us you were doing this to why didn't you do this sooner? So you're doing a great job, Carlos, from my perspective.
Okay, thank you. I appreciate the feedback. It means a lot to us. When we look at page 14, this is the second set of recommendations. So I just mentioned the first one. We worked with staff to keep investments between 1 and 5 years. We refer to that in our shop as a short bond strategy. That's just our internal name. We looked at every portfolio that we manage to this short bond strategy, and we lump them together to generate returns so that we can get an idea of what that approach nets for people, what kind of return you're getting, volatility, what characteristics. I'm going to show you that. That's called a composite. I'll show you that in the next page. And the reason I want to show it to you is because I'm trying to give you an idea of what we're heading towards, what we want the portfolio to look like, okay? So that was the main one. As I mentioned, staff reviews and approves all sales before we execute it. We have to do that. We can buy things at will. They've given us discretion to do that. But for the first few months, staff has requested that they be involved at that level, and we're happy to do that. We collaborate well with staff. Also, any reinvestments that we do are going to be subject to California government code. The compliance culture at our firm is very important. We have electronic means to track that. We have pre and post trade compliance to make sure that you hire us to make sure that you follow the law. The last thing you want to do is stand in front of a city council and have a citizen come in and beat you up over an illegal investment. So we take that very seriously, and we have various measures to make sure that that happens. The other observation is the next step, sort of the next level, we've gotten started, but the next level is to start really diversifying this portfolio more. We want to introduce asset classes that are allowed by California government code into the portfolio, but we cannot do that. There are certain asset classes that you currently don't include in the portfolio. And my guess is probably because, as every other city in California, you don't have resources to hire a full-time credit analysis team to do this for you. So we have that. We have a full-time credit analysis team and a committee. And there are asset classes in there that we'd like to introduce tactically to be able to move this portfolio forward from a diversification standpoint, from a liquidity standpoint, and also from a return standpoint. We can't do that until we update the policy. We'd love for you to update the policy tomorrow, but you do have a cycle, and we want to be respectful of that cycle. We understand that that policy will come to you, the council, sometime in the spring of 2026. When that time comes, we'll be coming forward with some additional changes to the investment policy. If we go to the next page, this is that composite. Again, it's a grouping of every portfolio that we manage in our shop to a 1 to 5 year mandate, that short bond strategy. So this is what the average 1 to 5 year portfolio looks like. Here's what I want you to what I want to highlight. Notice the U.S. Treasury component, almost 44%, a little bit over two-fifths of this portfolio. Currently, you hold 0.82 in treasuries. In a safety liquidity portfolio, that is the backbone of safety, and it's a danger to not have that much. Whereas you have something like 32.25% in federal agencies, and you can see here that the federal agency amount, the component in the average portfolio, is closer to 8%. Why is that? The reason is because treasuries are considered safer and more liquid than federal agencies, and you're supposed to get more yield for the additional risk that you take from buying a federal agency. But that spread, that additional yield for the additional risk, when I started in this industry, was 42 basis points, 0.42%. Today, you're lucky to get 2 or 3 basis points. That's 2 or 3/100ths of a percent above whatever the Treasury pays you. So when you had a pickup 20, 30 years ago this much, that pickup is this. And in some instances, you actually get paid less for the federal agency. It's cheaper sometimes for them to finance themselves than the U.S. Treasury. There are technical reasons for that. But you're not getting paid. If we're going to take on risk, we want to mitigate that risk, and we want to get paid for that risk. And those federal agencies just haven't done that. So we're looking to change that about. So that's the big change. The other big change is that we have some asset classes in here that are allowed by code, the ABS and the CMO. We would use those. Those are a little bit different, but they're allowed by code. We have capabilities in analyzing these, and we want to be able to use them tactically in the portfolio. Overall, what I want to leave you with is this. This is a large investment program and very visible. This is the city of Palo Alto, for goodness sake. And it's stakeholders looking at this. You want to make sure that you meet those objectives of safety and liquidity and return in that order. That's how they're mandated by code. We aim to do that. We're going to do that incrementally. We're going to do that in collaboration with staff. Staff knows everything that we're up to because they have vetted us up and down, sideways and upside down. They've made sure that they understand what this is before they felt comfortable putting us in front of you. So we're going to do that in conjunction and in collaboration with staff, and we're going to do that within the confines of California government code. I'll stop and take any questions you may have.
Okay. Alex? Good.
Well, I have the least finance background on the team, so I'll go first and ask a few little questions and then turn to the rocket scientist and the hazardous waste dude. Just want to say, Carlos, seriously, I said it at the break when you were at your halfway point, but I have gone from what are they doing? Why are they doing this? To like, wow, why didn't they do it sooner? And I mean that. So now the questions turn critical in a different way. But I thought your presentation was outstanding. Really invested in me a lot of confidence, and so thank you. My specific questions for you are. So you're recommending or you're acknowledging that in our cycle, we would not be amending our investment policy until next spring. And it sort of begs the question, how much do we lose or how much less do we gain by putting that amendment off by 6 months?
You would be better off looking at that sooner rather than later, in our opinion.
Okay. Just shows I'm paying attention. All right. I noted that you do Section 115 trusts, and we have one of those, and it's not invested with you. And so a question for staff is, and for you perhaps, does it make sense to bring that under the same house, or is there wisdom in keeping that in an entirely different place?
Well, my marketing hat would tell you that you should put all your investments with us, but as your fiduciary, what I would tell you is, I think it's PARS that's running your portfolio. PARS is a fine shop; they do a great job. I know the principals over there because that's been merged with PFM, and it was all bought out by U.S. Bank. It's all under the U.S. Bank umbrella, and I was a director at PFM for 8 years, and I know the team there. Monique Spike runs that team for the state of California, and she is a formidable investment advisor and a personal friend of mine as well. So I would tell you that as your investment advisor and your fiduciary, I'd like to focus on this portfolio and get it in the right footing before we revisited things like that. But yes, I'd love to revisit that.
My final question is for our colleagues on staff. The initial skepticism within the context of are we appropriately using or overusing consultants was, wait a minute, we're moving the entire responsibility for managing our portfolio out. And so the question I want to ask is, so what have we netted as a result of that? So we're contracting with these guys, and I'd love to know what the net cost of the Chandler contract is, given the internal savings. There are people on staff who are no longer doing something, or they're not doing it to as great an extent as they were prior to moving over to Chandler. So I'd love a sense of what are we saving on the staff FTE side because we're going with Chandler, and what do we expect that moving to Chandler will improve our yield by?
So, great. Thank you for both of those questions. On the staffing side, as you heard this evening, the service level is tremendously different and more enhanced given the firm's capacity. And so that will look very different. The savings, as well as Carlos mentioned, they have access to institutional brokers and buyers, which means the cost of transactions for them as a firm is lower than for us. That's going to be difficult to measure, but just the cost of those trades, they have access to, I guess, platforms and outlets as us at only, $500 million we don't have. As for staffing, we're still evaluating that in the fiscal 26 process. As we look at, what does supporting Chandler in this role mean for city staff? Because we're not actively evaluating the market. However, importantly, we still need to manage and oversee Chandler just because that's our duty. What does that look like? And again, in other facets as well. So that is to be determined in this next budget cycle. We are bringing that back because we are looking at ASD as an organization. Now that this has shifted, this particular role did other duties in addition to this. So we are studying that as a part of studying ASD as a whole. So more to come there.
And do we have you to thank, Ms. Lai, for pivoting us in this direction since you're a relatively new member of the team?
It was certainly an observation I had when I came here with fresh eyes, that it was very surprising a portfolio of this size still had this practice. And so we started studying and analyzing, and we actually did analysis of the county to see if there have been shifts. And there have been shifts with some of our excellent neighbors in the county. And so it just kept building some momentum to see what we could gain. Thank you.
Thank you. And my last question is, so at a 2.46 yield, looks like we were getting about 11 million off of 541. Is that roughly right?
I apologize for that last question you asked. I think, you had pointed in our conversation previously, Carlos, that our portfolio is right now at about 2.4% when neighboring jurisdictions that Chandler also manages, such as Sunnyvale, is getting close to 4%.
Correct.
That's it for me.
Sure. Chair, I'll just end committee add, this has been an ongoing process, I think, to your point, committee members, on why did staff go in this direction? If you recall, about 5 years ago, we did an audit. Baker Tilly, as part of the work plan with Baker Tilly, we did an audit on our investment services. And the fact that we had significant key person risk, frankly, because it was done in-house, a single individual, as Carlos identified, there's a whole firm behind this. And so this has been an area that we've known is to be looked at. And to Lauren's point, as she came on, she's like, why are you guys doing this? And so, we've had both the Baker Tilly audit that the council had approved. This is a recommendation in there. So this will actually satisfy some of those audit findings as well.
Okay, yeah, thank you. Very good presentation. I'm very glad you're a fiduciary. The suitability criteria I don't think is appropriate for this. That's a really good news for the city. So you looked at the different pockets of money that we have. What kind of ranges of time horizons did you see in those different pockets?
We looked at anything that was needed a year or shorter, and we advised city staff to segregate those funds and keep them in short-term investments. That could be a combination of local agency investment fund, which is the state pool. Right now, it's a particularly attractive approach because as rates are falling, shorter-term investments fall quickly because they come due faster and they get reinvested in increasingly lower rates. So you're going to earn less. For short-term investments that are in the state pool, that state pool, even though it provides daily liquidity or next day liquidity, they tend to have a little bit of a longer weighted average maturity. So they reset downward slower. So right now it makes sense. The other avenue,
but it's not a money market, or
it's not a money market mutual fund.
It will verify. It will change its value.
Correct.
Okay.
Correct.
But it's short term, so
correct. So a money fund is dollar in, dollar out. There's a market value shift with everything, but as you're aware, those investments are designed to be stable value. They allow you to pull the variability, the delta in the market value. The market value shift is so small that they allow you to be able to move in and out at book value. So dollar in, if you invest $1 million in life, you're going to get $1 million back plus interest. It's not the $1 million minus whatever the shift in market value was. So we look for that for these short-term investments, like a money market mutual fund. Money market mutual funds are the other option. The other option we've discussed are local government investment pools. There are currently 3 in the state of California. We just launched the 4th, which people have been screaming for more options. It just launched last Wednesday. But those are much shorter. Those do look like a money market mutual fund and will reset shorter. Right now, because you've underutilized LAIF, we like that for you. And as a result, we've advised staff to keep those shorter investments, funds that are needed within the next 12 months or so in those types of vehicles.
And what do they hold? Or is it just state?
No, it's not an obligation to the state. They hold securities as well. Similar treasuries, sometimes agencies if they make sense, some corporates, it depends. Those are available online and public. Those are publicly available. They publish, I think, on a monthly basis what their holdings are. I could make that available to you.
Okay. Are they subsidizing it, or is it just that they're not taking profit?
There's a little bit of there's 2 little secrets to LAIF, and it's number one that the expense to you is very, very, very small. Where they charge, where the rest of the world charges on the assets under management, they actually charge as a percentage of the earnings themselves, and it's a tiny, tiny bit. And that's because they're the state. They're providing a service to you, and it's competently run. We know the team at LAIF; they do a great job. The second reason, of course, is that they're part of a greater program where state monies are involved. It's called PMIA, and I think what's happening there is that there's a little bit of a subsidy on the yield basis.
Okay. So now, from a velocity standpoint, and you're designing this, how paranoid do you get, right? How worried are you about the black swan, and how much can you put that out of your mind and just look at the nominal case?
We build portfolios for the what if. That's the first approach. We build portfolios for the what if because your goals are mandated by code in order, and the very first one is safety. Now, does that mean that you can mitigate? Well, can you get rid of all risk? Absolutely not. We can't do that. The global financial crisis proved that. The Lehman Brothers default proved that. The downgrade of AIG proved that. What is it? WAMU, and I can go on. Okay. And those were widely held by respected investors all over the state. Some counties held some of these things. Some cities held some of these things. So you can't mitigate everything, but you can take steps to mitigate risks that you take. A lot of that involves doing the analysis. A lot of that involves judgment. Our credit process is not the same credit process as a shop that handles fixed income for a pension fund because the goals are different. We deal with local governments, and local governments are different, and you live in a bubble. You live in a glass jar, and everybody's looking in, and we're keenly aware of that. You asked me if I'm paranoid. No, I'm not paranoid. But we win by not losing. We don't want to lose in a situation like that. And it's not difficult to make money off of a fixed income portfolio. You have to have the resources and the analytics to do that. That's complex. And unlike a stock portfolio where you're really dependent on the earnings potential of that entity, this is more economics driven. It's more about what the general direction of the economy is doing and where interest rates are going to be headed because of where the economy is going. And so there's a lot of analysis. So no, I'm not paranoid. We do think about that black swan, but you can't guard against everything. But what we can do, we do.
So when you pick that 43% of the U.S. Treasury, how much of that was due to you worried about a flight of safety and needing money and other assets won't be able to, you have to rely on that during that flight to safety? Or is it that you just think the risk reward for the Treasury is good?
The former. The amount that we have in treasuries on average for 1 to 5 year portfolios, for short bond portfolios, is a deliberate positioning. And that's based on our analysis. And generally that is wavered anywhere between 33 and 45%, depending on the client. And one of those reasons is because when you have more volatile times, when you're coming towards the end of the business cycle, when you've got uncertain fiscal policy, when you've got unknowns due to tariff activity that we don't know where it's going to end up. Generally, investors move more towards, they go up in credit, they go up towards safety. And one of the reasons you have that is for that reason.
Okay. And then, so you said that you're actively trading or actively managed. So we have a lot. When you look at those two slides, the portfolio is going to be changing a lot in the near future. So there's going to be a lot of trading, I would assume. But in steady state, if you look at your other clients, how much turnover do you have in a typical year?
Not a lot. Sunnyvale may have 3-4 trades a month.
Okay.
Okay. For you, you may have a little bit more than that, but we don't like shocks to the system. It's, if there's an opportunity, we'll move. If we have to take a loss on book value because we're reinvesting into something that's going to pay us that loss back to us and net you more money than had you done nothing, we're going to do it. We'll do that. We'll communicate it. But generally, the approach will be that we want to move this ship deliberately, but not immediately. Shocks to an investment portfolio aren't good. And we're cognizant that these are earnings. This is income that's budgeted into your budget process and will flow through your ACFR. And we're keenly aware of that. We want to work to up that income. We want to work to reduce that GASB 31 disclosure, that negative fair value markdown that you've taken in your income statement. We want to reduce that. And we want to do that as it makes sense, as the opportunities come in. Well, we're not just going to wholesale sort of flip this portfolio over.
And so you mentioned that it's going to be between 1 and 5 years, most of the holdings. Is that going to be pretty uniform, or will you look at the yield curve and say, oh, we should move up here and roll down the yield curve?
The latter, not the former. It won't be just uniform. And in fact, if you look at page number page numbers 15. Now, this representation isn't as good because we don't break out the 1 to, well, you have 1 to 2, then you don't have 2 to 3. There's it's a little bit funky. And in fact, I see a typo in there, but that second one is 2 to 3, not 1 to 3. But it's not a good representation, but that term structure that you have there is a dynamic term structure, and it is based on what we anticipate the yield curve will look like into the future. So we do quite a bit of analysis to do that. One of the tools that we use is a horizon analysis model, where we feed in 9 different interest rate scenarios, meaning 9 different shapes of the yield curve, and we assess or assign probabilities to those. And based on what our analysis comes out back to us, we will then use our judgment and our collective thinking as to whether we want to implement that and the timing of that. So no, it's a dynamic process. We're not just it's not going to be laddered across the board, because the term structure of interest rates isn't laddered across the board.
Okay, that makes sense. So I'm looking at the sector allocation on the right there, quite the distribution. I like the fact that we have more corporates. I think you can diversify out a lot of risk there and get paid for it, as opposed to having if you're forced to have a small amount of corporates, now you may have more single stock or single bond risk. Right?
Yes, that is correct. California Government Code allows you to purchase up to 30% of your investment program in corporate securities. Notice that we're not up at the top. There's a reason for that. But we would like to add more corporate securities. You currently limit corporate securities to AA or higher. If you look at the investment grade investment grade is BBB, followed by single A, AA, AAA, and AAA being the best. If you look at the investment grade world, you can't even buy BBB. You're not allowed to do that by code. So you have basically single A is the lowest. If you look at the investment grade world of single A and higher, something like 56 to 60% of the investment grade world is single A. So you're already, because you have that limit, you're shut out of something like 2/3 of the investment grade world that you're allowed to invest in. Your opportunities are limited. So we want to add those to the portfolio, but when we do, we want to do an analysis on every name that goes in there to make sure that it's going to do what we want it to do.
Yeah, I mean, it's different if you're buying a 30-year bond as opposed to a 2-year bond. You can project what a company is going to look like 2 years from now. It's much harder to look out 30 years and say.
Not everyone can, but yes, we'd like to think that we do a good job of doing that.
Well, as long as you're starting with investment grade, that you don't have that far to fall. The agencies, what do you think about Freddie and Fannie? There's been talk about privatizing that. Do you stay away from them?
We don't necessarily stay away from them as a rule because of the privatization question, which the Chandler view on that privatization is that it's not likely going to be ending up like the way people are thinking, and it may not be an event, is what we're trying to say. But we're not necessarily not buying them for that reason. We're generally not buying them because for a 3-year treasury, you might pick up 3 and 3.5 or 3.4, and for the comparable agency, you might pick up 3.41 or 4.2. I'd rather have the liquidity of that treasury than the additional 2 basis points from that federal agency.
And so what agencies are you using in that 8.2%?
Well, currently, federal agency issuance has really diminished significantly. When the government curtailed their mandate, their financing needs shrank. They didn't issue as much bonds, so there's less of a supply, and that's one of the reasons why they're very expensive. There's less issued. There's less supply, similar demand, so their cost to buy them goes up, which means to you that their yield goes down. That's why you're getting paid less. But that's a little bit of bond market math right there, okay? Yeah. But what I'm trying to say is we'll buy whatever's available, whether if it's a good value for the portfolio, we'll look at all of them. So that includes Fannie Mae, Freddie Mac, Federal Home Loan Banks. It could include Tennessee Valley Authority. It could be any of those. Currently, Federal Home Loan Banks is who's really issuing at the moment, and we're not getting that much yield out of that. So we're not finding a lot of value. Where we are finding value is in the highest credit quality federal agency mortgage-backed securities. They're called Freddie Ks. They're from Freddie Mac. We do see those. You don't allow those in your portfolio. One of the things that we will work with staff is to understand those and what they will do into the portfolio, and hopefully bring back a recommendation to you when you revisit your investment policy.
And would those be callable or not callable?
No. Okay. No, they would not be.
Okay. And what about like the CMOs? Are they?
Those are the
callable?
CMOs.
Okay.
The
Okay.
collateralized mortgage obligations.
Okay. So here it says agency is 8.2. That would be in the CMO, what you were just talking about.
But let's take a step back because I think you're bringing up a very important point, but it's nuanced. So the federal agencies, when we refer to federal agencies here, we're talking about the debentures, the direct obligations of the
Okay.
agencies. The CMOs are pools of receivables in the form of mortgages, and so those from a risk profile look a little different. So we carve those out. But to your point, from a legal standpoint, I think it was Assembly Bill 1770 allows you to treat those as federal agencies from a compliance perspective in your investment policy. They'll be called out in your policy under the federal agencies, but we will analyze them as a separate asset class and carve them out because you need to know what you hold in those.
Okay, very good. One last question. Asset-backed securities. Can you talk more about that and why that's in this?
Absolutely. For those of you that are not familiar with asset-backed securities, David Bowie, is everybody familiar with David Bowie, the dearly departed singer? David Bowie got royalties from his records and his songs that got played on the radio. David Bowie at one point decided, well, that's an income stream into the future. And I don't know how long I'm going to live to receive that income stream. So here's what I'll do. I'll securitize it. What I will do is I will get investors to lend me that money. Let me rephrase that. I will issue a David Bowie bond. Okay, so what I'll do is I'll get them to lend me that money. They'll buy that bond, which means they lend me that money. And what I will do is from those royalties that come in, I will pay them combined principal and interest payments. And then eventually they get paid off from that income stream, and it allows me to use that money today. Okay, well, we don't buy any David Bowie bonds. There's no David Bowie bonds in your portfolio. As much as I like his music, we're not going to buy any of that. But the concept is the same for asset backs. Primarily, you see that with credit card auto loan structures. I've seen that with, I mean, you can securitize almost anything. I've seen manufactured homes. We're not going to buy that. Airplane leases, car leases. The most secure that we find are auto loans and leases, and also credit cards. Now, here's where the financial.
What rating would that be?
So here's where the financial engineering comes in. What they do is those structures will divide up investors into categories, and those categories will stand in line to receive the first prepayments of that principal. So the closer you are to the front of that line, the lower the yield, but the higher the credit quality because you're getting your money back faster. So you have to understand what each of those structured, those are called tranches. Yeah. They're tranching. Here's where the financial engineering, we're only looking at the AAA tranches that are the most liquid.
Okay. But in the Great Recession, that we saw that some of those tranches broke down or weren't analyzed properly.
Actually, during the global financial crisis, the asset-backed market did not suffer losses. They actually came through it squeaky clean. It was the subprime mortgage market. Those are also tranched in mortgage-backed securities, and that was the problem. There were the lowest rated, which we would, as a rule, avoid.
But wasn't that subprime? Didn't they tranche it and have some AAA? The highest.
So with mortgage-backed securities, it gets a little bit more complex. Rather than just standing in line, you're also buying a piece of the lower rated. You can buy a piece of the lower rated. You can buy a piece of the higher rated. You can buy pieces that are interest only. You can buy pieces that are principal only. All of those have a time value of money associated with them. It gets very complex. Okay. So you think about this.
You've done your research and you think that there's
we do
a good risk reward.
We do.
Okay, thank you.
I've learned a lot. Thank you. At least we'll see how much of it sticks. So my only question is, given the staff support for the direction we're going and what I hear from my colleagues and committee support, why do we need to wait until next spring to update the investment policy?
Great question, because that was one of the things I was going to say staff was going to chime in on. Typically, it's come back as an item within the June budget adoption. What we're proposing is to bring that forward probably closer to February
Good.
So it's not during the budget madness. It's when the finance committee has a lighter agenda packet. That's when we're planning to bring it back in. That'll give us a chance as well to continue to partner with Carlos and firm on the recommendations that will be coming forth. So Chair and committee wanted to give you an update on the progress we've made and the firm, and also to kind of daylight some of the changes that we're going to recommend on the policy as well. So that way
Great.
you can stay informed.
I appreciate that. I just wonder why we wouldn't be able to talk about it at mid-year budget adjustment, just because it'll give us a projection of increased revenue for the remainder of the year. It feels like that would be an appropriate time to come as well. Is it just not possible to gather go ahead.
Mid-year is typically February, but I think
Never mind.
Yeah, I think there are
Okay.
two different exercises. One is updating the policy, which is very important because it allows us to instruct different investments. And two is how we forecast investment returns will still be based on the holdings we have in the portfolio. So we'll work closely with them as a firm to understand what that looks like for 25, 26 in the current year, plus 26, 27 and the out years. So
And is it correct that those anticipated improvements in return will take time to roll in? Yeah,
That's right.
and so like, do you have kind of a time horizon before we would get to what is more your standard rate of return?
I'd like to see this portfolio kind of fall in line within the next 9 months or so. It may take longer than that. It'll really depend on what we see. We are entering into a lower yield environment.
Yep.
Investors are, the Federal Reserve is recognizing that we are perhaps at the tail end of the business cycle, and as a result, the economy is in need of some stimulus in the form of lower interest rates. So they've embarked in an easing regime. The Chandler view is that there's room for at least 2 more rate easings from the Federal Open Market Committee through the end of the year. They've broadcast that themselves. When I look at the probabilities based on federal funds futures contracts, they're telling us that it is like 100%, but that's very fickle. What I will tell you is that because of that, it just means that from an income standpoint, the income will probably reset a little lower, and we have to be careful. One of the good things is that as the market rates fall, it diminishes your unrealized loss position. When rates fall, values in the bond markets rise. It's an inverse relationship. So as those rates fall, that loss is going to shrink little by little. We'll be keeping an eye on that very carefully, and again, moving tactically through it.
Okay, so thank you. So we're only receiving and discussing, but there's no action, correct?
correct.
In that case, we can go home.
Oh, no.
Oh,
Chipper,
sorry.
can I just say for the record, we do not have any requests to
Thank you.
speak on this item.
All right. So that concludes this item. Thank you all very much.
Thank you.
Yeah.
Thank you. Thank you.
And just update on upcoming meetings.
Yes, so on November 4th, we'll have a couple of items relative to the Regional Water Quality Control Plant. And then also the updated CIP plan, also of the Fourth Amendment to the Green Waste Contract. The second meeting in November, we'll have an update on major revenues, tax items, and then also utility items before you to review.
Thank you. All right, meeting's adjourned.